Hey, good morning, favorite people. How are you guys doing today? Good morning, Andy, Bob, Rob, Roku, all the cool kids. Grant, Miss Jen, Ron with the apple. Nice to see you guys. How's everyone doing today? Feeling good? Ready to do this? Kick it in like a dope house? Morning, Grant. All right, guys. Um, today, today, we're going to talk a lot about advantages and rules and what they look like and how you can see them and all those wonderful things that are going to make life easy on you. Good morning, Zorro. Um, it's funny. I spent 2 hours this morning, 2 hours, and I haven't taken a trade today. And it's not that I didn't want to be in a trade, and it wasn't that I didn't see a couple opportunities. Um, But there's a big difference between seeing opportunity and following your plan. And my rules never came to fruition. My rules were never true. Therefore, I didn't pull the trigger. And there's two ways that I can handle that after 2 hours. Is I can be upset that I'm not up money. I can feel left out because I saw other people making money. Or I can simply say it was not my money. My plan is comfortable to me. My plan provides advantages for me. And to be honest with you, I just don't have the desire to fight it because when I do, I don't typically win more than I lose. So, um, one of the things that we're going to talk about today is keeping it simple, focusing on a solid set of rules that are repeatable, focusing on a solid set of rules that make it so that your trades look the same each and every time you get into it. But before we do that, we're going to talk advantages. And what one thing we're going to do is talk about the advantage of being able to know when news is releasing. So today is Wednesday, March 20th. And at 10:30 a.m. today, there's crude oil inventories. So for you guys that trade crude oil, what you're going to find is that at 10:30 a.m. there's a pretty good chance that that market's going to bump and jump and spike and do the things that you wish that it wouldn't. The reaction to news can pull you out of a position. It can slip you hundreds of dollars sometimes if it's a big reaction. And we're not waiting. Like we're not clicking on the envelope and saying, man, I wonder if the change in the number of barrels held by commercial firms during the past week, is it going to be good? Is it going to be bad? And if it's good, man, what is good? Is it more? Is it less? Should I go up? Should I go down? And the reality is, guys, is it doesn't matter. It doesn't matter what they say. What matters is that you know when they're going to say it so you can sidestep that emotional reaction. You can choose to go make a sandwich. You can go pet your dog, stretch your legs, do anything other than put yourself in a position to get run over. And you'll also find that these prop firms, these proprietary funding firms, won't let you keep profits that are made trading during news because it's considered a windfall. If you get lucky and you end up on the right side of that emotional response, it's not a solid trading plan, and they won't give you your profits for you guys that are doing it. Just a heads up. And then, guys, this is the big one right here. At 2 p.m., we have federal funds, FOMC, 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 and notice that it's high impact, it's red. I want you guys to understand that red news can move the market. Red news can create problems. Red news that is FOMC statements makes the market look like a seismograph for about 10 to 15 minutes sometimes. And there is so much volatility that you'll literally see the market at 18,000 and a blink of an eye later it'll be 16.2. And then a blink of an eye later it'll be at 19,000. It's untradeable. The other side of the FOMC, guys, and I wanted to share this with you, is that today may be a little wonky. Yeah, 5K instantly. That's low compared to the best that I've seen so far, or the biggest that I've seen so far. Um, so the S&P, the Russell, the Nasdaq, Guys, these are the days where I'm not going to tell you how to trade. That's not my job. But these are the days where perfection pays off, where advantages pay off, because there's a lot of people with a lot of money that have the potential to be jockeying for position. And things that you'll find is that areas may overrun, right? You may not get the completion of the move. So you have to be willing to manage your trades. You have to be willing to really adhere to your rules to give yourself the highest chance of success, because there's a lot of emotion in the market today. Um, and I'm not trying to scare anybody out of trading. I just tend to be a little more cautious, and less likely to fight momentum indicators when there's all this news. So now you guys know when it is. And I put the link in there. That's part of my routine is every morning I check news, I look at it, I make sure that I'm not jumping in front of a freight train of emotion. And then everything that I talk about comes from the education page. One of the things that I really do appreciate about Nexgen, and one of the reasons that it makes it easy to work for Nexgen, is there's no holding back, guys. We don't give you a little and then here, let me charge you another $1,000 to give you what you need to be successful. Um, what we do is we say, hey, here is the best indicators in the market, and especially if you're on demo. Here's a platform to run it on. Here's a solid set of rules that have been tested over the last 27 years that NextGen's been in existence. Here's how you study it. Let me know what you think. And we'll give you everything that you need to be successful. We'll give you everything that you need to be able to be profitable in the market. And the only thing that NextGen can't give you is repetitions. The only thing that I can't give you is experience. So when I click on this tutorial section, I'm going to give you the best of the best way to gain experience with the highest probability of winning. And we do it with a high probability trend trade, guys. We do it with a trade that typically wins 70 to 80% of the time when you trade it per the rules. And this is a trade that's designed to build confidence through the memory of success. This is a trade that is going to help you understand advantages. And it's a trade when each indicator on every chart agrees for the rules of the trade. And this is when the triggers are their strongest and no termination conditions exist. And there's no trouble spots between the entry and your target, guys. And we talk about this high probability trend trade because it's nothing more than a pattern. All it is a pattern that repeats itself. Every market I've ever seen, I can find you high probability trend trades on the NASDAQ. I can find them on crude oil, the S&P, Bitcoin, Tesla, Apple, you name it, it's there. And we're just going to learn the patience to wait until it happens to enter the market, till the rules are met. So we're going to focus on this high probability trend trade. And the reason that I do it, and the reason I'm so adamant about you guys learning this trade first, and again, I'm going to say it, I don't really have a stake in your trading, but I do really enjoy your success. I enjoy celebrating your victories. So I want you to have as many of them as you possibly can. And this high probability trend trade is designed to turn you into a chart reader. And chart reading is the first skill that NextGen is going to help you master. It is, in my opinion, the most important skill that you could ever have as a day trader. If you're not a chart reader, you're going to be trading emotion and opinion. Once you can look at your chart and recognize advantages, well, then you can take a more pragmatic approach to your trading. Then you can trade when rules are met, when advantages are present, rather than hoping that things work out the way you want them to. Chart reading will be about 90% of your day. Telling you, I shared with you this morning, I spent 2 hours waiting for my rules to be met. And guys, the key word there is my rules. I talk to my brother every morning. My brother took a lot of great trades this morning, made a lot of money this morning, but his money wasn't my money. He has a couple different entry rules that he's willing to take. And it's not that his trades are wrong or that my trades are wrong. We just don't share the same entry method every now and then. And the more experience you have in the market, the more likely you are to adjust your plan. But you have to be able to read your charts. And that 90% is going to have you understanding where the market is likely to continue. And this will become the entry point for the high probability trend trade. You're going to understand where the market is likely to go, and it's going to make it pretty easy for you to put targets where they belong rather than hoping that the market gives you more than it's willing to give. And you'll also understand where the market is likely to stop. And we call these termination conditions. Termination conditions can end a 4-hour trend, and termination conditions can create fights between the people in charge. And termination conditions can behave as the anchor for the absolute highest probability trend trade that you could ever take. So we're going to focus on recognizing advantages at first, using our chart reading to understand momentum and when there's nothing in the way, and finding finally that trade entry precision. That's the second part of being a chart reader, is being able to use your reading to get into the market. So our first hour is designed to recognize the high probability trend trade. Our first hour will be dedicated to finding that trade entry. And then from that great entry, you'll find that you have manageable trades. So the quickest way to get to where you want to be, I say it every day, post in the room, guys. Post pictures of your trades, post pictures of your questions, post pictures of your chart reads. Get confirmation and get validation that the way you're reading the charts is the correct way to read it, because that's all we're doing right now is we're learning how to recognize advantages. And the more that you post in the room, the more likely you are to get to where you want to be faster. The second thing is use the spreadsheet. Nexgen gave you a spreadsheet. When you download the software, it automatically loads onto your computer. I'm going to put mine in the room right now for you. But guys, this spreadsheet is the most underutilized tool in your arsenal. The first page of your spreadsheet is a trade tracking sheet. It just tells you to, every trade you take, put it in there. And it's going to give you a drop-down menu that asks you how you felt. What type of trade was it? Was it coming from a termination condition that reversed the market? Did you have strength? Was there a loss of strength? And ultimately, how did you do? All of these are covered in the drop-down menu. But I really think that the most important part that you can do is there's a notes section. And guys, this is where you can put the feedback that you receive in class. We had a gentleman yesterday that took a trade, and the trade had every advantage that we teach. The trade had everything set up 100% perfect, and it didn't work. And if you're not posting in the room, you might begin to question yourself. You might begin to ask yourself, man, what did I do wrong? Why didn't this trade work? What's going on? But he dropped it in the room, and we went back to our advantages. We went back to our rules, and he realized that this was just a cost of doing business, that anything that wins 70 to 80% of the time has to lose 20 to 30% of the time. So he can put that in his notes, and his notes might be, don't miss this setup, even though it wasn't a victory. And if you study what you did yesterday to put yourself in a better position today, it will do just that. Asking yourself what worked and what didn't work, and what felt easy and what felt forced. Guys, you're identifying the patterns that bring you success, and then together we are confirming that those patterns are bringing you success, that they are high probability patterns. And then together we're also recognizing the things that aren't bringing you success. We're recognizing patterns in the market that might not provide you the advantage, but this is the key to the feedback, guys, is we're going to recognize patterns in you. And anybody that's been with me for more than a week knows that I'm going to find what you do. Some of you like to jump in early, and some of you like to trade into termination conditions. Some of you don't care for taking profits at key areas. And what happens, by your 10th chart posted, I've got you figured out, and we start working together to make it a little better. But this little historical study, pour your coffee, load your charts, it will prepare you for the day. It will accelerate the learning process. And then using the spreadsheet, let me pull up mine real quick. There's your trend trade tracking. The next one is your favorite look. What's it going to take to get you into the market? Anything that is rules-based, that the feedback was, yes, this is the best of the best, get that into your personal trade setups. You're beginning to build your plan. And then just so that you guys have something to click through as brand new users, there's about 300 pictures of Nexgen users being absolutely brilliant with the software. There's entries, there's exits, there is management. If you're a NASDAQ trader, guys, you have to go through all of these. This is going to help you. There's patterns that repeat themselves, and termination condition. So Rob, is it a definition that you need help with? Pay special attention when we talk about termination conditions, Rob. I'm going to cover divergences and how they affect you as the brand new user. And then again, all of this is foundational. You're going to begin to incorporate divergence into your trading plan as you grow as a chart reader. But in the beginning, we're going to keep it very, very basic. We're going to keep it very focused so that you don't have to overthink these concepts and you can find a little extra success in the bag. So we're going to learn the trigger line and the Fibonacci rules, guys. We're going to talk about when it's okay to trade. And the only time it's okay to trade is when your rules are met. And I know that it sounds, well, duh, Mark, but you'd be surprised at how often you want to trade when they're not met. I want you to keep practicing, but most importantly, I want you focused on trading the correct rules, because what happens is people love to post in the room. My rules weren't met, but I made $500. My rules weren't met, but I made $300. And what happens is Murphy is writing laws just for you. And all of these lucky trades that you take and you watch that pretend P&L go up, the second you turn live, it's amazing how the rules start working and those stop working. And it really sets you up for long-term failure. So the idea is practice like you want to play. Don't switch over to your simulator and go, man, I'm going to trade a 300 lot and fight everything and see if I can win. Because you're training your brain. Your brain doesn't know the difference. We're going to simplify. We're going to talk about a high probability trend trade, and then we're going to focus on one medium probability trade. I'm going to give you a rock solid plan for taking both of them. I'm going to give you a plan that gives you the heightened chance of success. And I'm going to give it to you in a form that's easy to follow, and we're going to talk about it. But the idea is you have to learn the looks so that they become easy. What looks will you commit to? That's where you have to work, guys. That's where you have to take pictures. The more pictures you take of advantages, the more times you see the ideal trade, the easier it becomes to catch it in the moment. The more times you go back and you talk about what's happening on your charts, the easier it is to catch that when it's actually happening live. And what it does for you is it almost slows down the market. So this is our plan for today. Remember, you have to tell me what you see. If you just drop a picture in and you don't tell me why you got in or where you got in, guys, especially if it's a winner, all you're doing is bragging a little bit. Hey, look at me, Mark. I'm kind of a badass. I made money. I have no idea how I did it. I can't repeat it. It has no value in the room, but man, look at me. Not your grandmother's refrigerator, guys. What we're doing is we're learning to chart read. So it's imperative that you take the time to tell me why you did what you did so that we can turn it into a lesson. Otherwise, I'm going to read it the way I read it. And this hurts feelings sometimes because I'm going to tell you, man, you traded right into a termination condition. And there's no doubt in my mind why you just got your butt kicked, right? So tell me what you see. Let's make sure that you understand termination conditions. Let's make sure that you understand good tops and bottoms. Let's be solid on the lessons of strong triggers. And then what happens is you get to be a chart reader. So we're going to do it with the high probability trend trade. It's only 3 rules. 3 rules. Each rule creates an advantage. The most advantageous thing that you can do as a brand new user is begin to speak to yourself in advantages. Don't say to yourself, do I have a long trade? Start saying, are my rules met for a long trade? Did I see a short trade? Were my rules met for a short trade? And even more so, I want you to start asking yourself, do I have momentum? Do I have a clear path? Do I have an entry area? Because these 3 advantages come from these 3 rules. And if you start talking to yourself in terms of advantages, not only does it make it easier to catch the high probability trend trade, but it lets you know what you're up against if for some reason an advantage is missing, which has you put on a management hat, which allows you to be a little more aggressive in what we call medium probability trades. So 3 rules, 3 advantages, that's the recipe for a trade. The first rule is the large chart needs strong trigger lines. Well, the large chart is the first chart that we're ever going to look at. The large chart is a broad stroke of a brush, and we can actually use the most current bar on the large chart, and that is going to define the direction of the market, which way we should be trading. It's going to define the momentum of the market, whether or not rule number 1 is met, And it's also going to define the areas, the places where the people in charge are most likely to have a reaction. And that's going to be rule number 2. This most current bar is going to give you all that information. Once you have it, that's when you go to rule number 3, and that's where you'll turn your attention to the smaller, faster chart. And the two charts work together for you because they're a representation of who's in charge. The large chart are the people that have the money. The large chart are the people that push the market, that create these trends, that establish the momentum. The large crowd are the people that react to these key Fibonacci areas. And you're going to have the easiest recipe in the world to make sure that you never get stepped on by the large chart or by the large crowd. And then there's a small crowd. This is your small chart. These guys fight the large crowd, and they win about 20 to 30% of the time, but they are always less likely to win. And these are the guys that are going to push you back to your best of the best entry. So what we're going to do is we're going to take a large chart, one bar, and dissect it with the small chart. And this is where your entry precision comes in. This is where you're going to be able to reduce risk, where you're going to be able to maximize profit potentials. But we have to start on the large chart, and the large chart must have strong triggers. That's rule number 1. And the only way to have strong triggers, ladies and gentlemen, is to go with the direction of the market. If the background is green, the large triggers, if the background is green, the market's going up. If the market is going up, the large crowd wants it to go up. There's no reason to look for anything other than the opportunity to buy, to go long. When the background is red, the large crowd wants it to go down. There's no reason to do anything other than to try to go down. And guys, this is gonna keep you safe. Never fighting the trend is a huge advantage just in the get-go, and it's not even a rule. But the only way to have strong triggers is if the trigger lines match the color of the background. If the background is green, your small triggers, these solid lines, this is a fast-moving indicator, moving average, and your large triggers, this dashed line, this is a slower moving average. These both have to be green. And then to have strong triggers, the small triggers must break away from and above the large triggers, like scissors opening, ready to cut. When you have this look, that's your strong triggers. And when you have strong triggers, the odds are favorable for the market to continue up. And you're going to hear in the room all day long, odds favorable momentum, odds favorable momentum. Hey, Bob, did you have odds favorable momentum in this trade? Ron, were the triggers strong? Did you have odds favorable? And you're either going to be able to say yes or no. You either have the advantage or you don't. In a downtrend, smalls below, larger wide, everything's open. Guys, this is where the odds are favorable for the market to continue down. And when they're strong up, you're going to pinpoint on that smaller, faster chart, you're going to buy Fibonacci support. On the large chart, it's going to look like a tail after the fact. That refinement process is going to have price come down inside of the bar and right back up. You guys are going to be able to pinpoint where this tail is most likely to form. Same thing when it's strong down. You're going to sell Fibonacci resistance on a smaller, faster chart. You will be able to pinpoint right where that tail is most likely to form. And guys, strong triggers should lead the way. Good morning, Jen. That's all right. It's nice to see you. Strong triggers pushes a market. Strong triggers breaks key areas. Strong triggers will even cover some of the mistakes that new users make. But strong triggers don't happen all day. At the top left, strong triggers, odds favorable momentum. Guys, short trades are the best. There's that tail. You guys pinpointed exactly where it was likely to form. But I'm going to tell you guys, you're not bound to strong triggers for the rest of your life, but as you're learning to be a chart reader, this is your best chance of success. This is the strongest push down and the most likely chance of finding a win. And then with both triggers down, when one of the small triggers is inside of the large trigger, this is the first sign that momentum is slowing. This is the first sign that you're beginning to lose that advantage of momentum. Short trades can still be taken if the other charts agree, which means that you have to incorporate a little bit of chart reading to make sure that everything jives and isn't fighting. And then finally, with both triggers down, once both of the small triggers are inside of the large triggers, you have a weakening or a slowing of the trend. And guys, pay attention to these next 3 words. Anything can happen. Anything can happen is the term that you're going to hear in class. When you have weak triggers, It may go up. It may push further. And weak triggers at areas can stop the market cold. This is your best of the best. This is your weakness. This is the one that's likely to continue. This is the one that's likely to bounce. So let it be pretty black and white in the beginning. Either you have strong triggers or you don't. Is everybody cool with that lesson? Let's see if I can find a chart here. Let's open up NASDAQ. Strong triggers, the market pushes up. Strong triggers, the market pushes down. The trigger colors don't match. And look at the indecision in between areas. Isn't that pretty outstanding? Strong triggers right from an area pushes up, and it's strong triggers that gets you down to that area. Look at the tails with those strong triggers. Look at the opportunity to make money when there is strength. There it is again. All day. Weak triggers, deep retracement. Weaker triggers, deeper retracement. Egads and little fishes. It really can be that simple, guys. Strong triggers are likely to push the market in the direction of the trend. So if you commit to that look, if you commit to strong triggers in the beginning, you're more apt to win. And then once you have them, we have to make sure that the termination conditions are false, that we're not trading into areas likely to stop the market. And for those of you that are in your first week, second day, third day, this does sound exactly like yesterday because repetition is the key to recognition, guys. I say the same thing the first hour every day. The second and third hour, when we start to look at your charts, where we start to analyze your chart reads and see how you're doing and what you can do better and what you've done wonderful. So rule number 2 says termination's false. No trading into areas likely to stop the market. What this does for you is it means that you have room to your profit targets. There's got to be room to make money. And then the advantage, we call that a clear path. We already have the advantage of momentum, and now we're looking for the large chart to give us a clear path. And if you look at the large chart here, it's green. The background is green. The market's going up. The momentum is strong. We have strong triggers. The scissors are open. The small are above the large. Everybody good with that look? There's your strength right there. Most current bar. Now we have to make sure that there's nothing in the way, that there's no areas likely to stop the market. We call those termination conditions. And a termination condition is just a Fibonacci-based indicator that may reverse the market. Notice that may is a different color and underlined. Areas break all the time, but you have to know when they're more likely to break. There's going to be a comparison of the area versus the T3 trigger strength and location. So we're looking for support, resistance, yellow 1-to-1, cyan divergence lows, magenta divergence highs. And guys, here's a picture of what they all look like. There's your red resistance. It's going to run horizontal. You're going to see them on the large chart all day long. Fibonacci support, yellow 1-to-1s, a divergence high and a divergence low. So Rob, here's lesson number 1. What is divergence? Guys, divergence is nothing more than a loss of momentum. And I'm going to show you how it happens. The sellers are in control. They're cranking. All the momentum, feeling good. Life is outstanding. And right here, for no reason at all, the buyers seem to take over. This is called a pivot. If, when this pivot is formed, there is a loss of momentum, if the buyers are capable of stealing the momentum from the sellers, you're going to find out about on the third bar up or the third bar down. This negative number will print. The negative number means absolutely nothing. It's a byproduct of the calculations behind the scene. But as soon as it prints and the cyan line blasts out to the right, you know that there was a loss of momentum. And guys, that's all divergence means, is there was a loss of momentum. So over here, the buyers love it. Strong triggers, they come up. And the sellers say, you know what? We kind of want that momentum. Why don't we go ahead and grab it from you? Right on the third bar, that negative number prints. That magenta line begins to extend to the right. Look at this one, guys. There was a divergence high from like, I don't know, a year ago, whatever. Probably just a couple hours ago. But it continues to extend as long as that line in the sand is in play. One question: with strong tops and bottoms, is divergence with a pivot considered strong? So let me make sure that I'm reading the question correctly, Jen, as we talk about divergence. Are you asking me if this look right here, let's blow it up a little bit and get it for you so we can draw on it. Is that strong? Is that a strong bottom? Is this right here? Should we be scared? Should we worry? Should we be ready for it to rocket to the moon off of that? I'll tell you what, I'm going to answer that in 1 second. And not only am I going to answer it, I'm going to try and do a pretty good job of it. But first, I want to make sure that you guys know that these are the areas that can be problematic. These are the areas where the people in charge are making decisions. These are the areas that we're going to use the trigger lines to know whether they're likely to stop the market, whether they have the potential to break, or whether they've already broken. So what we're going to do, Jen, is the first thing that we have to do always is run a comparison. And this is how we decide whether or not an area is likely to hold, likely to break, or if it's already broken. And it starts with price reaching the area. And this is the most important thing, is price reaches the area. And why is that the most important thing? Because decisions are made at Fibonacci support. And if the price never gets there, well, then there's just no reason for anybody to make a decision. So once price reaches Fibonacci support, check your trigger lines. If they're not below the support, don't take any more trend trades on the small charts. That's the simple recipe for just determining, no, we haven't even touched it yet, Jen. You don't have it yet, silly. Right now, we have to make sure that we can identify a termination condition, because if we can't do that, we can't identify a strong top or bottom. So the first thing is price reaches the area. And when price reaches the area, if the triggers remain above support or below resistance, that's an area that may stop the market, that may create an untradeable bounce, that may even just go sideways for a while the buyers and sellers fight. So the second half of that is when both the small and the large get beyond the area. Whoops, we'll put a stop sign there. When the small and the large get below support, both triggers, both lines of both triggers, well, support behaves as resistance. And when support behaves as resistance, that's a broken area. And now we have a clear path. So no triggers, no trade, both triggers, clear path. Is everybody comfortable with that? And I'll show you on the NASDAQ. It looks like the NASDAQ's going wild over here. Notice that the triggers don't get through, and there's your reversal spot, right? The triggers don't get through, and that's your reversal. Triggers don't break. Look at the bounce. Look at the bounce. Is everybody seeing this over and over? Price pulls back. The triggers are all above, and up it goes. Down it goes. So all it says is, hey, don't go short. Don't go long. Don't go into this area yet, because you don't know what's going to happen. You don't know if it's going to break or hold. Once the small and the large get to the other side of it, well, now the area is broken. Now you have a clear path. Now it's time to look for odds favorable momentum. Now it's time to look that you haven't reached the next area. And guys, there's that tail where you pinpoint. So right now, all we're doing is we're establishing when an area is broken and when it's not. Guys, and for the brand new user, this is the most basic way of looking at the market. It's the easiest way to look at the market. Allow it to either be broken or not. Have a clear path or don't. But what that's going to do for you is it's going to make you understand the dynamic of these areas. It's going to make you understand that these areas do break. And you can identify when they have the potential to break. And that's when the smalls smash through an area, but the large lag behind. So 50% of my trigger lines have absolutely decimated the area with odds favorable momentum, but my large triggers haven't made it to the other side yet. Guys, this is what we call a 50-50 look. It's not your chances of success if you take the trade, but what it means is 50% of your triggers have broken and 50% have not. So the area isn't broken, but this is the look that lets you know that an area has the potential to break because of all the momentum. This is going to be your first medium probability trade, but because the area isn't broken, you don't have a clear path, which means that you'll have to be able to identify the best of the best momentum and the perfect entry area before you ever think about taking that trade. So the very simple approach, guys, it's either broken or it's not broken. That's the high probability trend trader. Once you're comfortable with that look, you're going to throw in the next idea, and that is that areas do have the potential to break with momentum, that there will be opportunities for you to trade before an area breaks, but you just have to be a little patient and make sure that it's the absolute best of the best. Is everybody comfortable with this? Let me put this in the room for you so that you can see it. Because rule number 2 is the most broken rule out of all the rules. Rule number 2 is the one where people go short into areas and long into areas, and they can't for the life of them figure out why they keep getting stopped out. So rule number 2 is pretty important for your success. And then once you have it, whoops, sorry. When I draw on my Ninja, I crash it every now and then. Jen, here comes the answer to your question. So let me take a picture so that we can really get into when divergence creates strength. When divergence creates a good top or bottom. And we're just going to start on the left. Everything is up. Everything is going. And you can even see that the smalls are beginning to break above the large. Guys, there's a lot going on to the upside here. And then once it hits Fibonacci resistance, that's your termination condition. Price reaches resistance, the triggers remain below. That's your termination condition. And then Jen, here's your first look. Right about here, 1, 2, right about here, this magenta line prints, this negative number prints. And guys, now divergence is true. And divergence will continue to extend to the right until it's no longer in play, until calculations say, hey, you don't need to worry about that line anymore. So we know we have a termination condition, and that termination condition pushes us all the way down to Fibonacci support. I think hot pink is the wrong one for this lesson. When we get to Fibonacci support, all the triggers are above, no short trades. Guys, this is termination conditions in its most basic form. And then from Fibonacci support, when price reaches it, there's this phenomenon that I want you guys to see. There was room for an entire reversal bar to print before it ever hits those large triggers. We call this the gap theory. And anytime price reaches an area, whether it's a mid-band, 1-to-1, fibs, and those large triggers refuse to follow, those large triggers remain a full bar away, price is more likely to close the gap to the large triggers. They're a moving average. And what's kind of cool is that's just a safeguard that says, hey, don't take any short trades here. Don't fight that gap. You're more likely to lose than you are to win. And then from support, it does close the gap, and then it reaches Fibonacci resistance again. So Jen, here comes the way I want you to use these divergence lines to recognize strength in a top. When price reaches resistance, we know that that's a termination condition because the triggers are below. It also reaches a second form of resistance. The triggers remain below. And now we have what's called a pivot stop out. When price trades above the divergence high line and then back below, this is what we call a pivot stop out of a divergence high. And guys, pivot stop outs of a divergence high are one of the most ignored termination conditions. It's easy for people to calculate support resistance, but this divergence high, when price trades above and back below, no more long trades. And if that reverses the market, that's a strong top. And a strong top is the precursor to the highest probability trend trade. When that pivot stop out, not the divergence, but the pivot stop out is true with Fibonacci resistance behaving as a termination, it adds power to the top. It makes it even stronger. And then I've got a picture of it happening at a low, which is very similar. The pivot is formed, the momentum is lost, and all it is a loss of momentum on a pivot. And guys, this really isn't a very scary endeavor. The market loses momentum all the time. It's a byproduct of the fight between the buyers and the sellers. But when price comes back and retests that divergence low, trades below it, back above, and we get that pivot stop out, Jen, when this termination condition, right, just a pivot with a loss of momentum, now it's a termination condition. If this termination condition, no triggers through, reverses the market, now it's a strong bottom. And then it becomes even stronger when it coincides with Fibonacci areas. Does that help a little bit? Awesome. And then when this termination condition does reverse the market, guys, this is where you get the concept of a strong top. When a no triggers through termination condition reverses the market, it's a strong top. And when your rules are met for a high probability trend trade, odds favorable, haven't reached the next area, this is the trade right here that typically wins 70 to 80% of the time. This is the one that creates confidence through the memory of success. And I want you to see, this is the 90% of your day. 90% of your day is saying, damn it, I'm not making any money because my rules aren't met. 10% of your day is capitalizing when the rules are met. And guys, it's okay to do nothing. Every dollar in the market doesn't have to be your dollar. There's plenty to go around. So termination conditions teach you to be a little bit patient. Termination conditions let you know where there may be a fight and where decisions are being made. And even if the market is screaming to the downside, when it reaches these yellow 1-to-1s, it's okay to say, I don't know what's going to happen. And this is what I really want you guys to get out of this, is you don't know. Nobody with the control, nobody that can push the market this hard is going to call you up and say, hey, guess what, Jess? When we reach these yellow 1-to-1s, there's a good chance a lot of us are jumping ship. And we heard that there's a lot of buyers that are going to want to take over there. Nobody's going to make that call or send you that fax or read you that memo. But you guys have a simple recipe that when price gets there and the triggers remain above, you can wait for that reaction. You can see what the fight is. And then once again, I want you to see what happens. Straight off of that rules-based termination condition, the buyers push, and they push directly into, Fibonacci resistance, and all the triggers remain below, and there's no long rules met. And then the sellers push all the way down, and the triggers don't match. There's no momentum, there's no rules met, termination, no momentum, mid-band, large triggers are a full bar away. And guys, look at how long this fight goes on. And this is where I see people quite often losing $700, $1,000, forming opinions, trying their best to be first, trying their best to predict what the market's going to do. But what they're doing is they're trading opinions. They're not trading their rules, because the rules aren't met until we end up with momentum, until small and large get above resistance and it behaves as support. And then guys, there's that tail right on the bar, and that's your best of the best. That's the one that wins 70 to 80% of the time when it follows a termination that reverses the market, a strong bottom. It's what you don't do here that's going to allow you to capitalize here. And that's really what we're focused on right now, is being able to speak to ourselves in terms of advantages, being able to reference the idea that we don't have to be in every trade, that we don't have to be in every move, that we can let these guys fight it out. And when they're done fighting, well, then we'll just take advantage. And everything has to be about advantages. So I'm going to pull up a large chart one more time. And I want you guys to go through this with me, and I want you to see it. Where's my large chart? There it is. And let's just see what happens. Both triggers don't get through, and that starts it up. And I want you to notice this. Weak triggers, and it pushes right to support. The triggers don't follow. There's your gap theory. And then the sellers decide to take over. And sure enough, they create strong triggers, and there's one of those potential entries. Strong triggers down. That's what we call a 50-50. And on the NASDAQ, these pink dots qualify as areas. Pushes all the way up to resistance, and the triggers don't follow, full bar away, and it comes down to the termination condition. Weak triggers, right at a fib. Resistance holds, no triggers through. Support holds, and ultimately it breaks, gives you momentum. There's a tail. And then Jen, there's your pivot stop out. And this is the one that I wanted to get back to because I saw it when I was looking. And guys, I want you to see the timestamps on this. This loss of momentum right at a fib with all the triggers above happened in the middle of the night, guys. It was about 1 a.m. Eastern. That line continued to print all the way, and at about 5:15, about 5 hours later, 4 hours later, it became a pivot stop out. So the buyers pushed, and the sellers fought, and the buyers pushed, and the sellers fought. And look how they got right through the fib. But this is the line that the buyers put in the sand. And the buyers said, all right, jerk faces, you come back to this line. I don't care how much momentum you have. I'm going to let you get a tick past it, and we're going to zoom to the moon. And that's exactly what happened. And that is why these divergence lows really are so powerful. While these divergence highs really are so powerful, and you can see it there, sometimes they break. But right when we reach it, it gives us the opportunity to sit on our hands and wait and see what happens. So, termination conditions, guys, learn them. Take pictures of them. Ask about them. But sometimes the market doesn't make an area. Weak triggers, but everything is down. Market's pushing and it goes up. Strong triggers, clear path. Market pushes down. We see this a lot. I'm going to give you one more termination condition, but before I do it, I want to why in the room from you newer people. It is lines on the large chart that can be problematic. It's lines on the large chart that are where decisions are made. Is everybody okay with that concept? Because I don't want you to get scared out of lines on the small chart. Lines on the small chart are used for entries. Lines on the large chart are where decisions are made by the people who control the market. There is one termination condition on the small chart that will have me say rule number 2 isn't met. I don't have a clear path. That's 3 divergences in the same price range. 3 divergences, 3 losses of momentum, 3 printings of those cyan or magenta lines, guys. It may terminate a trend. There's that magic word may once again. It may terminate the trend. It may create a fight. It may create an untradeable bounce. It becomes more powerful when your trigger lines go from odds favorable to anything can happen. The small triggers work their way inside of the large. The momentum look on a small chart is no different than the momentum look on a large chart, on a tick chart, on a range bar chart, on a minute chart, on a day chart. Momentum is momentum is momentum. And when that momentum goes away and it couples with 3 divergences, the market is more likely to push up. And when that third divergence is higher than the previous, it's even more likely still. It creates a head and shoulders. So if I get 3 divergences in the same price range, rule number 2 is not met. I have a termination condition. I can't go short. I can't take that next short. That look at a bottom, that look at a top is going to help you identify by using the smaller, faster chart when the large chart may be changing direction on you. You can also use this if you're in at the perfect short. 3 divergences gives you a management opportunity. It gives you the ability to manage out, to collect profits, to really keep the powder dry, and then wait for the next best opportunity. So large chart set up. Large chart said momentum. Large chart said that we have not reached an area, but we have cleared the previous. The path is clear. Is everybody comfortable with the large chart? The large crowd. The people in charge, the guys with the money, the girls with the money, they said, we're going up fast, and there's not a damn thing in our way. This is the best look to buy Fibonacci support on a smaller, faster chart. When everything is up screaming, we're going to buy low, and we can buy low because of the refinement process. When everything is screaming up, we're going to, or down, we're going to sell high. Good morning, Cav. Because we can refine using that smaller, faster chart, that one bar, the large chart. We can take one bar with momentum and everything in favor of a trade, and we can turn it into 15 to 30 bars on a smaller, faster chart. The bottom of the most current bar, guys, there is no tail at this point, will begin the beginning of a pullback on a smaller, faster chart. The top of this bar, the tail, ideally, will be an area inside of favorable large triggers. So by selling high, it increases room to the targets. By selling high, it reduces risk. And that's what rule number 3 is designed for. Let me go back to rule number 3. When the large chart says go, you guys are going to buy or sell a pullback. And remember, that pullback is the little shove that the small crowd gives. When the large crowd says everything should go up, there's these yahoos that are so willing to fight everything. These guys that are like, you know what? We don't care, large crowd. Doesn't matter to us that you want to go up. We've got a lot of money. Dad gave me his Amex, and I'm going to go short, and I'm going to fight everything that you do. And we love the small crowd because these guys give us the push right to our perfect area. And rule number 3 says that we're going to use a limit order to buy or sell a pullback, that little shove that the small crowd gives us, at an area. Remember that the areas on the large chart were problematic. Areas on the small chart are where we are going to enter high probability trend trades. But here's the key, guys. We want them inside of what we call favorable large triggers. Favorable large triggers mean that your large triggers and your synthetic triggers, both are just large triggers. The smooth large triggers, these are the ones that we establish momentum with. The synthetic large triggers, these are just the large triggers from the large chart. That's all it is. But we put them onto the small chart as well because when they are one on top of the other, two snakes riding piggyback, guys, this is the most advantageous look. The further they are apart, the more risk you'll have on a trade. The further they are apart, the more indecision you will have on where the market is likely to continue. So when they are one on top of the other, we call these favorable large triggers. Favorable large triggers make life better. They really do. And rule number 3 says that we're going to use a limit order to buy or sell a pullback at an area inside of favorable large triggers. And that gives us the advantage of an entry area, guys. This is where all of your chart reading comes to fruition. And we're going to use the small chart to refine, to pinpoint the best of the best. We're going to buy low. We're going to sell high. We're going to refine bars. And dag nabbit, we're going to do it at areas inside of favorable large triggers. And this is your entry. And we're going to go through it. I'm going to pull it straight from the spreadsheet that I gave you. When the large chart is up, remember, we're looking at the most current bar. The first thing we look for is odds favorable momentum. And guys, this is a great way to annotate your large chart. The scissors are open. The space is there. The market is screaming. This is the best of the best. Price hasn't reached the fib yet. My path is clear. Rules 1 and 2 are met on the large chart. And it's one of those strong bottoms, Joan. It's a termination with no triggers through that reverse the market. And there is a divergence there, right? There was a loss of momentum. I like it, but the divergence doesn't mean as much to me as the fact that no triggers broke through support. So now it's time to look for an entry. I'm going to look at my triggers. I'm going to look at my areas. And I'm not going to worry about a red line on a small chart because it's the large chart that defines the areas. But I have to wait for the small crowd to do their thing, guys. I have to wait for the reversal bar on the small chart. And let me go through a couple things on this. The reversal bar is not your entry. The reversal bar signals the beginning of the pullback. Once it happens, I want you to look for those triggers. I want you to look for the large. I want you to look for the synthetic. The trigger lines are not your entry point. Areas inside of trigger lines are where the trades happen, but there's an order of operations. I'm going to wait for the reversal bar. When it prints, I'm going to look for the triggers from the top line to the bottom line. I know that my areas have to be somewhere inside. Once I have that, this is where the magic happens. Once I have that, now I find my areas, fibs, midbands, yellow 1-to-1s. The black box goes from the highest point of support inside of favorable large triggers to the lowest point of support inside of favorable large triggers. And guys, this is your window of opportunity. The woo Ric Flair fans. The window of opportunity is where the market is most likely to continue. Trigger lines are a correction point. In moving averages, correction, there's a whole big deal with it. Areas inside of trigger lines give the market something to bounce off of. This is like throwing a baseball as hard as you can. And until it hits the chain link fence, you have no expectations of it bouncing, right? That's what the areas do. So from the highest point of support to the lowest point of support becomes your window of opportunity. Your job as a rules-based trader is to right-click on your chart and activate a limit order right at that area of support, right inside or just above the highest point of support inside of favorable large triggers. This becomes your entry, guys. This is your best of the best. Going short, it's the same thing. The rules have to be met on the large chart, and I wait for a reversal bar. Once I get a reversal bar, I look for my triggers from the top line to the bottom line, knowing that this is where price is likely to correct, but I want to identify the areas within the triggers because this is where it's most likely to bounce. This becomes my window of opportunity. Once I do this, all there is for me to do is activate a limit order and pray. Hopefully the small crowd gets to me. Guys, these entries are exactly what you should be working on for your first couple weeks with Nexgen. Having the patience to wait for the reversal bar. Really letting go of that fear of missing out. Identifying your trigger lines. Are they one on top of the other? Are they trending together? Are they giving you the least amount of risk, the tightest area? And then finding the areas within. That's what the cyan box. And you'll get to the point to where you'll say with no hesitation, this cyan box right here, this is where the market is most likely to continue, and I'll be good gosh darned if I don't put a limit order just above. And you're going to learn to ignore the areas beyond because it's beyond the correction point. Is everybody cool with the recipe for finding an entry? You're going to have to go study it. You're going to have to practice it. You're going to have to simulate it. You're going to have to make mistakes, but put your mistakes in the room. Put your victories in the room. Things that freak out new users. The first thing, one divergence on a small chart means absolutely nothing to me. Thank goodness it happened. It may be the loss of momentum that I needed to get me down to my entry. Momentum is defined on the large chart. If my small triggers turn against me, thank goodness it's that loss of momentum I needed to get me to my entry. So guys, don't let little things on the small chart freak you out of the best trades. And that takes a little bit of practice. Everybody hates to lose. I want you to get in the mindset that you're going to lose. Sometimes it's not going to work. But if you wait for the reversal bar, if you identify the triggers and then the areas within, you're going to pinpoint with pretty amazing accuracy where the market is most likely to continue. And when you put them side by side on a chart, next slide, Jas, I got you. I want you to see how the two work together. The top of the bar on your large chart with odds favorable momentum, with a clear path, that's the beginning of your pullback. And remember, price is all the way up here, guys. There is no tail. No tail has formed. I have decided where the tail, I have pinpointed where the tail is most likely to form by the areas inside of favorable large triggers. So Jas, this is how I want you to study. If you go back on a large chart and circle the tail when the rules are met, and it lines up with an area inside of favorable large triggers on the small chart, well, you have a high probability trend trade. And what you should do, if you really want to get to where you want to be, everybody, is you should take a picture of that. And you should say, hey, look, there's my strong triggers. And that is my clear path. And there's my entry. And then you should share that link and get it to screencast, or you should copy that picture and you should paste it in the room. And you should say, hey, Mark, am I reading this right? And when I say, holy smokes, that's the best looking trade ever, you should come to your spreadsheet, go to your favorite looks, and you should drop that in there. and you should say, you know what? This is my best of the best. This is the one that has every advantage that I need. This is the trade that I never want to miss. This is my perfect high probability trend trade long, and I'm going to commit this look to memory so that it becomes easy. And the cool thing is if there was a problem with your picture, we would talk about it. We would talk about maybe there was a termination, maybe there was a loss of momentum, maybe your entry was all the way up here because you were scared of missing out, and then your risk was huge and your profit potential was reduced. So I want you guys to get comfortable. I want you to build trust on your entries, because when you know where the market is likely to continue, Jas, there's your segue, you also know where it shouldn't go. So your initial stop is going to be placed where the market should not go, generally 4 to 5 ticks above the trigger lines, above that window of opportunity. Because if this is where the market is most likely to continue, then up here is where it shouldn't go. If this trade's going to work, it shouldn't go beyond that area. The pattern is no longer true. The rules are no longer true. The advantages are no longer present. And guys, it's better to let it hit a stop at 7 or 8 ticks out than it is to take a full loser, a $300-400 loser, because you hope the market goes down. It's already told you that it's not. Let it hit the stop. Take the loss. Anything that wins 70 to 80% of the time has got to lose 20 to 30% of the time. It's a cost of doing business, ladies and gentlemen. It's a normal part of a positive equity curve. And as a gentleman in the other room likes to say, it's just allowing the market to be wrong. Every now and then that small crowd has a little more giddy up than we anticipated for. So the quicker you get okay with the idea that you're not going to win every trade, the faster you commit yourself to only trading with the advantages that give you that higher probability, then the easier it becomes to accept these losses and then just reload and wait for the next one. And then once you get a reversal bar in the direction of the trade, you can reduce your risk even further, a tick or two above that reversal bar. And guys, this is pretty outstanding, because even on the trades that don't work, if you commit to your stop placement, I've seen people lose 2 or 3 ticks on a trade. I've seen people take such precise entries that they lose $30 or $40 on a trade. And man, I'm telling you, that doesn't sting. I also see people lose $300 or $400 on a trade when that market goes way beyond where it was supposed to correct, because they had that fear of missing out. They had that fear of loss, and they said to themselves, if I just keep moving my stop back, maybe it'll go up. Maybe the trading gods will smile on me even though it's not perfect anymore. And that's usually when you get stopped out, and you get stopped out for a big loss. So that's our first hour, guys. Every day. It's the same first hour. Every day, it just revolves around advantages. Every day, I say the same darn thing. Weak triggers are likely to push back up, right? Let me hide that. Mid-band with the large triggers a full bar away, it's likely to pull back. Trigger line colors don't match. I don't have the advantage of momentum. Do you guys see how many rules are not met? Hey, Grant, have a good one. Did you post a second chart in? You did. Let me review that for you real quick, if you don't mind. Guys, one of the things that I want you to realize, and Grant, is the color of your background has nothing to do with the rules for a trade. It's important that you understand that. And I know that we like to say that it is red, but we're looking for the triggers, right? Just because it's red doesn't mean there's a trade. Strong triggers means there's a trade. So here we have weakening triggers, but you do have a clear path. You entered on the first bars that pass through the resistance. You put your stop above the wick, and you were hoping that it would go down. So you were relying on a clear path and an entry without the advantage of momentum. Does that sound about right? I just want to make sure, because you know when we talk about understanding what your advantages are, so if you didn't have momentum, or it was slowing, 2 divergences doesn't kill you. Your stop is in the right place. You had an area inside. All you did here, Grant, is once again is you took a medium probability trade. You gave up the advantage of momentum, but you still had a clear path in an entry area, and all that means, it doesn't mean that there isn't a trade, ladies and gentlemen. It means that it's a medium probability trade. It means that Grant is aware that he may have to manage aggressively. Kept a tight trace with the stop loss due to the two divergences. So one thing to do, Grant, I love tight stops, I really do, but arbitrary stops get hit all the time. Your smaller, faster chart will have fluctuations, and arbitrary stops are like throwing a half-eaten tuna into a shark tank. It's going to get slaughtered. These guys know where the fear is. There's got to be a level of commitment, but without the momentum, wait for the loss of momentum. Maybe a reversal bar gets you out. Does that make sense? At least give it a chance. Otherwise, you're going to find yourself over trading because you keep getting stopped out. It's a great read. It's a medium probability trade. Once again, you managed aggressively because it was. And guys, there's a lot of money to be made on these trades that aren't high probability. But if you were in at 49, but you didn't get in until it got all the way down here at 45, right? So you were in at 45, 44, and you were out at 36. Just trading the areas is great. And guys, when you develop trust in the trade, when you develop this idea that you're very happy with the advantages, that you recognize the advantages, that you are very comfortable with the advantages, it's going to allow you to sell on the way up. It's going to empower you to have virtually no risk on a trade. And that momentum is going to allow you to get to that next area. And guys, this is a perfect example of odds favorable and a clear path. And when the reversal bar prints, guys, let's do this. This is what it looks like on the large chart. The very bottom of the bar is my reversal bar. Once it prints, I look at my triggers and I look at the areas inside of them and make this little window of opportunity. Whoops. Does everybody see the midband and the yellow 1-to-1s inside of the triggers? Fibonacci resistance is on the wrong side. Your job, guys, is to right-click and activate a limit order a couple ticks below that area. And guys, this is what's freaking amazing. The midband comes down. Maybe I lower it a couple ticks so I don't miss it. Don't want to trip over pennies. And it comes right back to it. So now we're in at 87.25 instead of being in at, what is that, 300 or 07.25, 300. Guys, that's $140 difference. That's $140 more risk. That's $140 less profit. And that little window of opportunity that you guys created where you knew exactly where the market was likely to continue, that lines up right with the tail. So go back and study these tails. Does it give you a rules-based entry? And what you're going to find is that you begin to develop a little bit of faith in the idea that selling high is way more advantageous. Buying low is way more advantageous. It gives you a better risk to reward. It gives you the ability to have virtually no risk on the trade. And guys, we really are, at the risk of sounding cocky, we really are that good with what we're doing. We are so good at identifying areas likely to stop the market. We're so good at identifying when we have momentum, and we're so stinking good at understanding where the market is likely to continue that there's just no reason to have tons of risk on trades. There's just no reason to take these maybe trades, guys. You're better than that. So one of my favorite sayings, and this was brought to me by a trader that I very much respect. He's a gentleman that trades I don't know. I think he trades 8 or 9 months out of the year and spends the other four vacationing. Not a bad way to live. He said to me one day, he goes, Mark, if you don't have a written plan, you don't have a plan. And I was like, well, I know my plan, right? Because that's what we say. I know my plan. I know what I'm looking for. And he says to me, he goes, no. He goes, because the second you're bored, you're going to deviate and look for trades. Or the second you think you have a trade, you're going to take the trade based on your thoughts and not on your rules. So he told me, he said, one of the most important things that you can do is have a written plan. So guys, I'm going to give you a written plan right now. This is the KISS plan, and I'm dropping it in the room. And this KISS plan, Keep It Simple Sunshine plan, is an accumulation of private sessions with you guys, really. It's an accumulation of my own follies as a trader. It's an accumulation of my 3.5 years in the market and also my brother's 27 that Nexgen has been around. This KISS plan is a stepping stone in your learning journey. This KISS plan is designed to help you become a chart reader. This KISS plan is not the end of the road for 90% of you. This KISS plan is also the plan that has been utilized by people in their first week or two with Nexgen to get funded by firms like Apex or Top Trader. This KISS plan, most people tell me they typically win around the 80 to 85% range when they follow it. This KISS plan is designed to keep you out of lower probability trades. So through simulation, study, class feedback, and continuous practice, guys, you're going to create a plan tailored to your personal goals. You're going to create a plan that suits your needs. You're going to create a plan that takes all of your warm fuzzies and rolls it up into your best entries and your best management. But until you're a chart reader, until you can read the indicators, this is going to optimize your chances of success. And your simple plan is simple. Don't fight the large chart. Don't do it. You're going to want to get in early. Don't do it. You're going to want to say, well, this area has to hold. Don't do it. Not as a new user. Just don't fight the large chart. Don't fight the momentum. Don't fight the direction. Don't trade into those areas, guys. Keep yourself on the safe side of things. Define your entry. And this is the most important step for new users. I'm not saying make money. I'm not saying anything other than define your entry. Define the point where the market is most likely to continue. Get good at that. Go circle tails. Your first 10 days with me, if you go back every day, if you go back every single day and you circle tails on the large chart and see where they line up on the small chart, and if they're at areas inside of triggers, guys, by the end of 10 days, if you do this on 3 markets, 10 days each market, and you're going to go back and circle the same tails, you're going to have this look absolutely engraved in your mind. And it's going to be like the market just slowed down. It's going to be like the trust is there. And you're going to be absolutely amazed at how quickly you get to where you want to be. If you decide that you don't want to do the work, if you don't want to define your area, well, let's have fun spinning our tires together. This is the high probability trend trade. This is your first trade. This is the best of the best. This is the beginning. And guys, here's a checklist for you. I've never had anybody follow the rules of this checklist 100% and do worse than 70% winners ever in the history of the checklist. Print this out, put it on your desktop, and guys, every time you annotate a chart, write these rules on the chart. Take the time to type it out. Don't copy paste it. Take the time to type it out and put an arrow on there. If you're still working on what the looks are, this is your strong top or bottom, a termination that reverses the market. And guys, there's an amazing video on these checklists that my brother put together about when areas are likely to hold and likely to break. I would recommend watching it. This is what your strong triggers look like, and there's that yucky anything can happen. The area is not broken. It has the potential to break, but not broken. Now the area is broken. There's your window of opportunity. Guys, you can keep it simple in the beginning. You can keep it focused in the beginning. All you have to do is define your entry, because great entries create manageable trades. And I know I sound like a broken record and I'm up on a soapbox. Tops and bottoms video, Lyle. Take the checklist. Follow the link or just go to the tops and bottoms section on the education page. It is right there, right off the education page. This is, in my opinion, one of the best looks at creating the easiest understanding of when areas are likely to hold and likely to break. But guys, once you define your entry, you have to do something with it. Once you get to the point to where you can pinpoint where the market is likely to continue and you do enter at that point, you've got to manage the trade. Management takes chart reading, and many of you will recognize this. And you'll say to yourself, when you post in the room and I'm like, okay, that second higher divergence said, let's jump ship, or those three divergences, you're literally thinking to yourself, man, I didn't even see that. I didn't see that happen. I didn't see that divergence print. I didn't notice that things changed colors because you're so focused on learning the entry. That's okay. So management in the beginning can be very, very mechanical, the same way your entries are very, very mechanical. And you will craft a plan to manage your trades based on your experience reading the indicators. Once you're a chart reader, things get easy, guys. But your initial stop is predicated by where the market shouldn't go. Your initial stop is beyond the window of opportunity. When you look at your stops and targets that are in NinjaTrader 8 put there for you by Nexgen, if you're trading crude oil, the S&P, gold, if you're trading the Russell, it's set at 12 ticks. 12 ticks is not your stop, guys. Your stop goes beyond the window of opportunity. Sometimes it may be 7 or 8 ticks. Sometimes it might be 17 ticks. But the idea is that you put it where the market shouldn't go. And if it goes up and hits it, guess what? It's cost of doing business. But with the advantage of momentum, with the advantage of a clear path, with the advantage of pinpointing the perfect entry, it's more likely, not guaranteed, not definitive, it's more likely to give you a reversal bar in the direction of the trade. And if it does, you're going to reduce your risk. This is the only movement you're going to make. You're going to move your stop 2 ticks above that reversal bar for a short, 2 ticks below that reversal bar for a long, and you're going to sit on your hands and you're going to roll 6 feet back from the desk, and you're not going to do anything because you're learning to trust the indicators. You're learning to read the charts. And if you are terrified of losing money on simulator, guys, they're going to have to steam the pleat out of your chair once you go live. So get used to the idea that that stop's going to get hit. Be okay with it. Watch it happen. Go, man, they got me. But with all those advantages, make them come get you. Don't offer up your stop because you're afraid of losing money. They know where it's at. And guys, the market fluctuates on that small chart, right? Look at that bar right there. If you tried to go break even too early, they got you and then they ran because they know that that's where all the chicken people sit. So let it do its thing, and hopefully its thing is hitting the first target. And with all those advantages, it's hard not to. And the first target's at $100, guys. $100 isn't a lot of money for most people, but $100 every day for a week is $500. And $100 every day for a month is $2,000. And guys, that's 24 grand in your account from only making $100 a day. That doesn't suck. But the $100 isn't designed to make you rich. The $100 is designed to make you feel good. I just got paid, and you're going to move your stop to break even. And guys, break even's ridiculous. It doesn't make sense. But you will craft a plan tailored to your personal goals based on your experience reading the indicators. You'll understand when it's more appropriate to leave a little risk on the table. And if you're getting paid at $100, guess what? You don't feel bad about leaving 80 on there because your worst case scenario is break even. Right now, your worst case scenario is 100 in the bank and break even. You're going to move your stop to break even, and you're going to once again sit on your hands and slide back. Either let that break even stop get hit, and it will a lot, or let it hit your second goal of $200. So 1 trade, 3 advantages, 2 contracts, $300. Guys, this is outstanding trading, and $300 feels good. And if that's the best you do every day, that's a $72,000 year at only $150 a contract. And I think that's the part that people forget, is that you don't need to make all the money. You can get above the median income in the United States on $300 a day. You can get into the upper middle class on $500 a day. You can get into the 1% on $500 a day and just mirror it on 20 accounts. So it's not more trades. It's not anything other than the best trades, guys. And it all starts with your ability to read the indicators, and keeping it very simple in the beginning. And the more you fight it, the longer it's going to take you to get to where you want to be. The more you'd be cool with 75 grand a year. How could you not be? I mean, granted, you're going to give 30 of it back in taxes. But guys, that's a pretty good living, isn't it? 125, if you make $500 a day, $250 a contract, and I feel comfortable saying that there's nobody in this room that can't do it. That's an outstanding living where your job entails doing absolutely nothing for 90% of the day. Guys, this is the NASDAQ on FOMC day. I haven't had clear path or momentum for the last 45 minutes. I haven't had a rule met in the last 45 minutes. You can make a choice. You can either fight termination conditions without momentum. You can see flat triggers and decide to go long anyway, or you can just sit on your hands and do nothing and wait for the advantages. And guys, FOMC days can be horrible days to trade. Crude oil inventories is coming up in 10 minutes. You can see that resistance to support to resistance, and then we get a little breakdown to support. But is it just me? Or does it look like they're winding up for something? Does it look like there's a huge fight right between key areas? And because I'm a Nexgen user, because I knew where those areas are, because I can use trigger lines to determine whether they're likely to hold or break, I didn't have to give anything away. And I can say to myself, I either need to break above here or below here before I ever look for a trade. So guys, are there any questions about the high probability trend trade? Are there any questions about momentum? About termination conditions? Are there any questions about pinpointing an entry? Any questions about being able to scroll backwards on a chart? And let's just see what this one looks like. That termination reverses the market, and that's the beginning of momentum, and I'm dollars to donuts. That's not my best look. That's all the way back to yesterday. They've been fighting on this crude oil inventories day. But if I scroll back to that circle, well, it certainly does pull back to a mid-band right inside of a trigger, but it's not favorable, large triggers. That may not be your trade. But if you annotate the chart with the rules, you'll know for sure whether it was or not. You'll never have to ask, hey, Mark, was this a trade? You'll simply be able to say, hey, Mark, my rules were met. It either worked or it didn't, right? My rules were met, Mark. Am I missing anything? And that's what you guys have to start asking is was my chart read correct? So that's our first hour. First hour every day is rules. First hour every day is advantages. First hour every day is designed to help you become a chart reader. The second hour, guys, the second half of class, this is where it's on you. You guys tell me what we're talking about. I'm going to start clicking on the pictures that you guys posted. I am going to talk about them regarding your chart read. I'm going to talk about them in terms of advantages. I'm not gonna beat you up if you make a mistake. I'm going to talk about how to correct it. I'm not going to get mad at you if you trade into a termination condition. We're literally going to go back to termination conditions and make sure that you understand the lesson. And we're going to do the same thing with momentum. If you're telling me that it's strong triggers, but it's not, then we're going to go back and have that lesson on strong triggers. And that's all we're doing, guys, is we are establishing your ability to be a chart reader, to talk in terms of advantages. And Jen, I don't know if you caught it at the beginning of the day. It's FOMC day, right? It is FOMC. And at 2 o'clock today, that market's going to go absolutely apeshit. And sometimes it's really nice to trade after once it settles down because there's tons of movement. But it's not uncommon at all to see a horrible day on FOMC day, guys. And that's why I was so picky this morning. That's why I didn't take chances this morning, because really there's a lot of people that are nervous about what they're going to say. There's a lot of people with a lot of money that don't want to do anything until they get that release. Remember, it's not all your money. So guys, I'm going to take 5 minutes or so. Maybe I'll take 6. I am going to encourage you to do the same. I'm going to encourage you to stand up, to walk away from your computer, to fill up your glass of water, to go breathe some fresh air, to do something other than maybe 7gen. I've been known to take a 7-minute break. Probably won't, but I could. Um, we talked the other day about the longer you sit in front of a market and your rules aren't met, the more likely you are to break your rules. The longer you sit through this and you don't see an opportunity, the more likely you are to begin to predict, the more likely you are to hope that your hopes produce a result. So I'm going to walk away. I'm going to breathe deep through my eyelids. I might even play on my phone for a second. Who knows? But when I come back, we're going to start clicking on all your pictures. So guys, go take care of yourself for a second. I'll be back in a minute. What's up? What's up, Big Booty Judy? How you doing, babies? You're so good. You're such a good dog. You're such a good dog. Does she want a strawberry? Does she want a strawberry? Strawberry. Yo. Here we go. That's it. That's all I have, Ben. All right, baby, I got to teach, okay? Oh, you're such a good girl. You're such a good girl. I love you. I love you. All right, I have to teach. Here we go. All right, was that 7 minutes? How'd I do? I'm going to tell everybody it was, so we're good. Nope, you just got to figure it out. It either works or it doesn't. I don't know. There was a, what was the movie? Bull Durham, maybe? Where Tim Robbins and they tell him, breathe, breathe through your eyelids. It's like a running joke. Check it out, guys. That was a 50-50 trade on 2 areas with divergence. And some of you just got stopped out wondering what the hell just happened. I can't stress enough that what we do are patterns. And I'm dragging my feet right now because crude oil inventories comes out in a minute. So let's watch crude oil and hopefully we see that reaction, but maybe we won't. I was 5 minutes. I was close, right, Jay? I stink at taking breaks, guys. I stink at not working. My wife thinks it's hilarious. She's like, everybody wishes that they didn't have to go to work, and you're miserable when you're not working. And I'm like, yeah, that's about right. So here come the inventories. The trigger lines don't match. We're right at areas. There's no clear paths either direction. Let's see if they react. And I don't know if they're going to or not. Well, yeah, looks like they did, huh? Just a little bit, not huge. But somebody was waiting for that news. And that looks like about all they were going to do, huh? That's not so much, but there we go. Now they're starting to push. Now we've got some motion. Now I've got a 50-50. Now I've got split triggers. Where are my areas? I don't have areas inside of favorable large triggers. I didn't reach resistance yet. I do have odds favorable. I don't have a clear path. What do I do? I don't know. All right, guys. So we're going to start looking at pictures, and we're going to start talking about what you guys see and what I see. And then you folks that trade the NASDAQ, I've got the best picture ever for you. And we're going to take a look at it. We're going to start with Grant's chart, though. And this is pretty cool. Chart was still red when I placed the sell limit order to enter the trade, but changed to green while in the move to hit his projected point. So once again, colors, guys, the only thing that we use the colors for is the only way you can have odds favorable momentum is if the colors match. And I think it's important that you guys understand that because the entry point on this chart was up here. And by the time we got there, it wasn't still red, it was green, which means that the small triggers were above the large triggers, which means that there wasn't momentum. But there was a clear path, and that was that 8 o'clock fib update. But even that fib wasn't there, so there was a clear path, and it's the tail end of momentum when it starts the pullback. But by the time it gets to the entry, guys, what we're looking at is an area likely to stop the market. Grant gets in, and I like this trade because the large triggers are down. All the triggers are below the area. It's resistance. It's likely to stop the market, but it's not high probability because the areas aren't inside of favorable large triggers because the momentum is no longer the best, but the path is still clear. He takes it and manages out of trouble, guys. And that's how you take a medium probability trade. You look at what the indicators are telling you. You establish whether or not you have enough of an advantage to take the trade. He felt that he did, but he managed it aggressively because he knew that it wasn't high probability. And that's all we do, guys, as we talk about advantages. All right, VM Tech. Let's make this a little bigger and let's take a look at it. And I'm going to go ahead and go full scribbles on this one. And there's a couple things that I want to talk about. First and foremost, I want to talk about when you annotate a chart, guys, and how important it is to be truthful with yourself about your annotations. 703, 703. So my pink arrow lines up with the entry. Um, and you'll notice that the entry is directly into Fibonacci resistance. The entry is 100%. There is momentum. I'm coming off support, but the entry, and you can see it on both charts. And let me get those pink arrows off of there because I don't think pink's the right color for this one. The entry is directly into Fibonacci resistance. It is 100% into fibs to the tick, not a clear path. And I'm not saying this to say, dag nabbit VM Tech, why on earth would you do that? That's not the right thing to do, grr, grr, grr. I'm saying that because VM Tech told me that they had a clear path. But the reality is it isn't. Price reached the area, the triggers didn't break. You can see it to the tick on the smaller, faster chart. Therefore, you traded into trouble, not from trouble. And then trouble gave you a bounce. And it gave you a bounce all the way back to support inside of favorable large triggers. So the one thing that I want to say is if you're going to trade into trouble, if you're going to break that second rule, make sure that you have momentum. And the momentum was there, and the smalls were outside of the large. And make sure that you're in at the best spot, not trading directly into it, because what does it mean when we hit resistance? Decisions are being made. Usually, there is some sort of fluctuation, which means that if you trade directly into a fib, it's more than likely gonna knock back. It's more than likely going to push at least a little bit lower. And sure enough, it pushes directly to Fibonacci support inside of favorable large triggers. And you're absolutely right. That would have been a much better entry. It would have been less risk. It would have been higher profit potential. And because you know exactly where the market is likely to continue based on rule number 3, your risk at this point is maybe $100 rather than having to sit through 140 per contract. And I'm not saying that it's a bad trade. And this is the one thing that I like is you put a stop below Fibonacci resistance. And this is where you guys realize that you're learning lessons without realizing that you're learning lessons. And I'm going to go full clear. We talked about the entry. So now we're going to talk about the exit. And I want you to see how important language is. Put a stop below fib, below red resistance. And why did you do that? I put a stop below resistance because I know resistance can stop the market. Is everybody good with that? And there's a lesson that I'm getting to. I decide to exit below Fibonacci resistance because there's no doubt in my mind that this is a horrific spot for me to hope that the market breaks. Does that make sense, everybody? What a great place to take profits. If you know that that's a great place to take profits, does it make sense to trade 2 ticks into the same condition down here? And this is where you'll get with your chart reading and you'll start going, man, I never even thought about that. I never thought about it because here I don't want to lose money. Here I don't want to give it back. Here I know that it's problematic, and because it is, I'm not going to sit and hope that it breaks. But right here, you haven't made money yet. Here, you're hoping that you can make some money. So your entry is aggressive with the hopes that it breaks to get you to the next stop. Here, you don't want to give it back, so you take profits at the exact same location. Guys, this is a huge, huge, huge psychological lesson for you guys. Your best entry is here. Your fear of missing out gets you in here. Your best exit is taken because your fear of giving back overrides your hope that the area breaks. I love this. And VM Tech, I know that you're going to watch this tonight. I hope that that all makes sense for you. And I absolutely love that you made $470 on this trade. But if we go back to the live market, can't we agree that termination conditions are more likely to stop the market than they are to break? And because so, doesn't it make sense that trading from termination conditions rather into termination conditions creates a huge advantage, and it will help us in the long run find consistent profits? And that's where I was going with that. So I went a little deeper into VMs here because she doesn't have, or he doesn't have, the advantage, I'm not sure which it is, of typing in the room, because some people still have to go to work. But I wanted to make sure that lesson was good. And guys, it's a huge lesson on the psychology. And then I'm going to go through Gary's trade. But before I go through Gary's trade, I want you to see exactly how this one worked out. So before Gary posted his trade, I was taking pictures of a 50-50 trade that failed. And a lot of you guys love these 50-50 trades, these potential to break it. And that's exactly what this one was. The large triggers hadn't come through the areas yet. It was only 50-50. And it didn't come from a termination condition that created a full reversal, which means that it came from a bad bottom, not a strong bottom. So one of the things that I know to be true is that when price doesn't reach a key Fibonacci area and it reverses, the mid band's more likely to hold. The 50-50s are more likely to fail. And guys, if any of you took this long, I want to see it in the room. One divergence can kill a 50-50 trade. Two divergences just annihilates most of them. So a lot of people get long right here and they can't for the life of them figure out, hey, take care, Lyle. And they can't figure out, well, why didn't that work? I had an area inside of favorable large triggers. Well, usually it's because you don't let the large chart lead the way. When you begin to recognize these patterns, when you go through and you do your study and you start to see these things over and over, what's pretty awesome, and Gary just did it beautifully. There was a bad bottom that gave a 50-50, and you'll notice that Gary doesn't go long. He knows that that's problematic, but he doesn't stop right there. He lets his chart reading say, well, hell, two divergences, 50-50, bad bottom, this thing's probably going back down. Once I get price a little bit below, once the small triggers get below the large, once I have the advantage, I'm just going to ride it down. I'm going to take that failed 50-50 and make some money on it. So Gary, I hope you're listening in here, because right when I finished typing out this picture, you were locked and loaded, ready to take advantage of the failed 50-50. So rather than taking a loss, you got paid. And I think that it was absolutely brilliant chart read. Nicely done. And then we went over Grant's before he left. All right, Bob, let's see what you did, my friend. 50-50 from a good bottom. Upon realization where the entry should have been, should have pushed just below to the large mid-band. Seeing pullback, read to go below 1-to-1s, put entry below small mid-band, could go to large mid-band, hit fib price to small mid-band, pulled 8 ticks from entry. Oh, good Lord, Bob. All right, help me out here. So let's do a couple different things. And I hope this is helpful. Large chart leads the way. So the large chart defined your direction, which was up. Large chart defined your mid-band, or your termination conditions, which was a 50-50 at 52.42. So far, so good, Bob? At this point, the large chart's done. There are no entries that come from the mid-band from the wrong side of everything on the large charts. Entries come from the small chart. Looking back at charts, seen reversal out of nowhere, did the same thing at 10. It's just a 50-50 trade. And it's a 50-50 trade. It doesn't look like you had divergence into it. You didn't, right? There was no divergence, and there was strong triggers, and you took a beautiful entry. And then you get a lower divergence right off the trouble spot, and this is where it went south. Bob, you followed every rule that I've ever taught for a 50-50 trade. Strong bottom, odds favorable, probability to break, perfect entry, no divergence. And then you get the reversal bar, and the management for the 50-50 says get out at the first trouble spot. And that was $100 profit. Even if you hold through this, that was $100 profit, and that's where you get break even on a 50-50. And you actually could have turned this into a $100 trade with maybe just a little bit of commissions lost. And what scares me is I don't see your second exit. I see 2 contracts in, and I only see 1 contract out. So where's the second contract? Because I think that's the real discussion here. If you didn't exit here with odds favorable momentum on a failed, they pulled them together at the stop, okay, cool. But do you see how there just isn't any reason to give that much back on a 50-50? Bob, you killed the entrance. It was the absolute best. But because it's not high probability, it's okay to eliminate that hope. And even if you get out with the divergence being true, you still only lose a point, $50, instead of losing $250 each or whatever that was. I always stink at the math. So perfect entry, great management lesson. When you know it's not high probability, it's important that you understand what it's going to take to manage it, and how aggressive you want to be managing it. Gary. Gary's always good for the gifts. Nice job, Bob. Termination, right? You took the first long against everything. Gary, thank you for posting this. I think support is going to hold. Watch this, guys. I think, whoops, where's that? Where did that go? I think support is going to hold. Do you guys see it? Everything's down. The triggers are strong. I really think support's going to hold. Oh, shit, I got run over. Versus support has held. And suddenly it gets easy to make that money back. I think this blue line is going to hold. This blue line is held. Gary, this is one of the greatest pictures. And I'm not even going to worry about your market flow chart because, actually, you know what? I am. Because you love to say that the triggers rolled, and they didn't. They were odds favorable against you. Everything agrees, and it's easy from the termination. And guys, this is one of the biggest things that I see people do. And Gary is a very solid chart reader, so I'm not knocking Gary at all here. And what he did, though, is he shows how opinions can get in the way sometimes. I think it's going to hold, and I get stopped out. And what happens is a lot of times you guys go, well, I really thought it was going to hold, so let me trade the pivot stop out. And you get stopped out again. And then you're like, oh, shit, there's a fluctuation. Let me get long again. And you get stopped out the third times. And Gary avoided all that. He made one mistake and collected. So Gary, props to you on that one. And then it reaches Fibonacci support. And then the large triggers roll. And then the smalls get above the large. And you're on the correct side of the synthetics. And then Gary takes what we call an HVA trade. And one of the easiest ways to get rich as a day trader is to learn how to avoid the opinions, I think, and change that phrase into it has. And I hope that makes sense for you guys. I think it has. This was my Achilles heel for the longest time. And I don't want Gary to think he's alone here. I would go long here and get stopped out. So I would go long again and get stopped out. So I would go long here and here and here and here. And then finally, when the perfect one set up, I was broke. and I couldn't take it. Zorro, take care. So good job only taking one, Gary, and then going, no, that's not right. Let it be perfect. I love the trade. I love your trade. But remember, if you have these charts, guys, if you're trading those fast trigger charts, don't fight the fast triggers. It almost never works. Almost never works. It'll let you get lucky just enough to kick your ass 37 times after. Don't ask me how I know, but it's not a happy story. All right, Bob. There's the 50-50. It didn't work out. And then directly into resistance, not one trigger broken. Is that really your setup for the next entry, Bob? What kind of trade is this that trades indeterminations? What kind of trade is this that trades without areas inside of favorable large triggers? What kind of trade is this that has all of your bars on the wrong side of the momentum indicator? Is it really a short trade? Or is it a good bottom that put in a bad top that came back to a perfect termination condition? Is it possible that that market was going to continue up more? I can't find any rules met, and that's why I ask. I see triggers not turned. I see setup for entry. I see you identify a termination condition, and I don't know why this is a setup. Should be what? And Bob, I hope you know that this is all coming from a place of love when I do this, right? If we just go rules met, rules not met, you have violated 2 of the 3 rules. You've forfeited 66% of your advantages by activating that limit order. And I'm not saying that it can't go down from here, but what I am saying is that the likelihood goes down exponentially into this blue fib that has already told you it loves to hold twice. And then the bad top. What did it end up doing? Do you remember? I'm just curious. Those are the ones that I get lucky on when I make a mistake like that. And I get lucky on it just enough to make me want to take it every time. And that's the same picture. And then Roku, you took the short trade off of resistance with everything down. Everything is up. Came in at a fib, small triggers a little wide, both triggers are strong, jump into the market, took your trade up to resistance line. So what you did, Roku, is you said odds favorable, with all that strength coming off a good bottom, I'm going to take it up to resistance, but I'm not going to get greedy, I'm going to get paid at the line. I like it, really nicely done. Bob, you reposted on accident, that's the same one. Oh, you went short. Nope, that was your stop. What I got, Bob, was the same picture, and that was probably an accident. Let me see if there's one below that. Maybe it was this one. Let's take a look. Oh, look, it lost. Damn. Did you have the stop too low? Did you have room to the target? Did you even have strong triggers? You certainly didn't have an area. How much risk is appropriate on something like this? What I see is a termination condition that's rolling the small triggers. Yeah. It's okay. I love that you took this one, Bob. And I'll tell you what, if there wasn't Fibonacci support below you, I would get on that one with you 100%. I would say, hell yeah, Bob, that's a great spot to give it a shot. But why not? Let me give you something to think about. It's FOMC day, Cav. Let me just give you one thing to think about. I'm going to make the font a little bigger. if I don't have momentum, if I don't have a clear path, if I don't have an area inside of favorable large triggers, notice how I just talked about all the advantages that are gone. Maybe it would be better to trade my opinion with the formation of a reversal bar. Something to think about, Bob. Absolutely nothing told me that that market was going to go down from there. Nothing. Everything was against it. Why not at least make them give you a down bar in the direction of your trade? If you're not going to have momentum, if you're not going to have an area, if you're not going to have a clear path, why not make them confirm? Because the cool thing is if they never do, you don't lose the trade. Does that make sense? And I want you to see where the reversal bar printed and where your entry is. It's the exact same price. Pretty cool, right? And guys, I'll never say, Bob, don't take this trade. I'll say you forfeited every advantage that I teach. It's low probability. I mean, it's even a pivot stop out here. At least make it confirm for you, right? At least say, market, give me a down bar. At least then I can establish my risk. Market, give me a down bar. At least then you're going the direction that I hope it goes. And what you'll find is that little patience, that little insistence. It'll keep you out of a lot of trades. And it'll get you into those ones where your opinion's going to be right. So I hope that was helpful. Let's see what we have. So you have a pivot stop out. Everything rolls. You do have momentum. The smalls were a full bar away. You didn't take that one, and that's okay, Ace, but great recognition there. Absolutely beautiful. And you said, well, now I've got room to get to the trouble, so let me just get in on a little snapback when everything's green. Get in, get out, get out. It's really hard to argue with this one. It's not your best entry, but it's a great continuation entry. And your risk is pretty much established. And every chart says go. And the best part about it is you still had room to get to the fib. So Ace J, it's a little late on the entry, but you still had every condition right. And the smalls a full bar away is not a crude oil thing. The smalls a full bar away is not a crude oil thing. It's a NASDAQ specific, 100%. You're welcome. That's go with the area because that's 32 flavors of awesome. And that's, I missed out on 32 flavors, but there's still 17 left. Let me grab a few of them. Nice trade. Did you overthink the entry or were you just not there for it? Sometimes you just aren't there for it. Not there. All right. Andy, termination, odds favorable, clear path, perfect entry, money. Pull back to the 1-to-1, first target met, second stopped out quick. That was on the Russell. So guys, this is the epitome of everything that we teach. Termination, strong triggers, clear path, perfect entry. He had 2 ticks of risk, hit his first target, went break even, easy money. Andy, that's absolutely beautiful. Those are those effortless ones. Those are the ones that you're just like, I'll do this all day. Triple dog dare you to keep me out of that trade. Not there, that happens, Ace. And then this is, I hate when I have to post this one. Who was this, Haji? Awesome termination, beautiful momentum. Great lesson on entries. Got excited on the entry, came in way too early. Nevertheless, There's your rules-based entry, right? There's your first reversal bar still inside of the window. You're out at the right spot. They just didn't want to go. So Haji, I like it. No, it's not even a beating, man. It's a termination. It's strong triggers. It's a clear path. The challenge is the split triggers, right? Because we don't know where the correction's going to be. We don't know if the correction is going to be to the large triggers or the synthetic triggers. We don't know if the correction is going to come from the one-to-ones or from the resistance up there. And then Haji, this is another one of those times like we talked to, you should hate split triggers. Split triggers are that angry girl that you dated in high school. She beat you when nobody was looking, but you kept going back to her, right? Because she entices you. But you just don't know. It's not as easy. But what's cool, Haji, is let's go back to the lesson that we gave Bob. So Haji, this is as sexy as it gets, right? This is the best large chart I've ever seen in my life. This is a termination. That's the greatest momentum. My path is clear. Guys, I would sell a child to fund the trade that comes from this. But then this one isn't perfect. The entry chart isn't perfect. So once again, and it didn't result in a winner, but once again, when it could be here or here or here, it's okay to insist that the market, they would bring them back. Haji, I love your trade. But this is one of those instances where when my triggers are split, it's okay to insist on a reversal bar to get that confirmation in the direction. If for nothing else, it defines your risk. So sometimes they don't work, right? Sometimes it's perfect and they don't work. But when the entry isn't perfect, that little confirmation, suddenly you're in at 45 or 54.5, and you still take the loss. It's still a 10-tick loss. But it works out, right? Gary, I use a 13.2 and a 5.1 for the Russell. The Russell's just like the S&P. And I don't think it moves fast enough to warrant the higher time frames, personally. But that's got to be your personal choice. But my Russell charts are normal 13.251. So Haji, props on the trade. Little jumpy on the entry. Great chart read. And hopefully just a little something to help you when you're looking for those entries and it's not perfect. Guys, I love reversal bars when it's not perfect. Termination, the beginning of momentum. Divergence off the termination, second lower divergence. There's that little no divergence snapback. And Ace J's like, man, just wish you were me. And I think we circled this one, didn't we? All the momentum, that hadn't even printed yet because it was an 8 a.m. Fib update, probably, maybe 2 p.m. Perfect, right back to the triggers. It's not a perfect trade, but with this level of momentum and this level of momentum, he takes a shot, and sure enough, it goes to support. It's a nice one, Ace. TLC, is it okay to place the entry at the furthest point on a split and chase it when it turns? You can do anything you want. You can put it at the furthest. You can put it 173 ticks above. But why would you chase it, right? Split triggers. What if you put it all the way up here? And I'm not saying this is my entry. Let's go back to Haji's. So your furthest point is right here. But that was confirmation. Yeah, that's confirmation. What if it goes from here? And it gave you confirmation that it wanted to go from there. You can do whatever you want, but the thing is the second you throw chase into it, It means that you're going to let your emotions take over to say, oh shit, it's going without me. All my fears are escalated. Let me jump into the market. And then how reasonable are you going to be with your management if it was an adrenaline rush that gets you in? I know my answer from my own personal experience is I don't manage trades well when I'm full of adrenaline going into them. Because I start to hope, I start to wish that it would go, I start to want it to go. But when I take the same entry every time, when I have odds favorable, when I have a clear path, when I notice that my correction point is beyond my trigger lines, I choose not to take it because it creates anxiety. And anxiety is a horrible recipe. These magenta dots were never reached, Andy. The magenta dots were never reached. Price never got to them. Those magenta dots had absolutely no bearing on your trade whatsoever. Does that make sense? Let's go through the rules, guys. And everybody help me out, especially new people. Did I have odds favorable momentum at the time of entry? Give me a wire and in, guys. Play along. You'll be smarter for it, I promise. Joel, I'm going to try it again. This is my bar. Do I have odds favorable momentum going into the trade? Yes, absolutely I do. That's the best of the best. Do I have a clear path, guys? Or a clear path? Price hasn't reached an area. It's cleared all the areas. Someone give me a wire and in. Is the path clear? Hell yes. Okay, so JW, why is it a no? I didn't reach yellow 1-to-1s. I didn't reach Fibonacci support. I didn't even reach those little pink dots. Divergence didn't print till up here, but that's not even a termination condition. JW, this is the clearest path I could ever hope for. I've got so much room to get back to my targets. Referring to the midband on the large chart? I just want to make sure we get the lessons in here. No worries, JW. You're always good with me. All right. So let me write my third rule on the chart. Was there a pullback to an area, and you know I'm going to go all caps, inside of favorable large triggers? From the top of the triggers to the bottom of the triggers. Help me out, guys. Do I have a fib, a midband, or a yellow 1-to-1 inside of favorable large triggers? No. So there's the thing. And guys, this is the lesson that I'm trying to instill on you. When I talk about your areas beyond, and Andy, this is going to help you. So triggers are where I expect the market to correct. So guys, give me a Y in the room if you're with me. This white box represents where I expect the market to correct. It's a moving average, it's the regression of the mean, and all these cool things that are smarter than I am. This is just where I expect it to go to. But it's just a correction spot. When I put an area inside, I give it something to bounce off of. And once again, guys, give me a Y, because this is such an important lesson, and it's going to keep you out of a lot of trades that are going to fail. Once my areas get to the other side of the correction point, the likelihood of them holding goes down exponentially. So this was Andy. So Andy, I'm going to say it one more time. With this look, with this out freaking standing look on the large chart, but the entry isn't perfect, is there any reason that you can't wait for a confirmation bar? Is there any reason that you can't force the market to establish your risk, to give you confirmation that this momentum and a clear path is in fact doing what we expect it to do? And guys, I think that we're seeing this a lot right now. Waiting for the confirmation. Waiting for the confirmation. When it's not perfect, guys, it's okay to wait for confirmation. But the problem with that and the challenge with that, and guys, please raise your hand and correct me if you ever think that I'm mistaken on this one. The problem with waiting for the confirmation is this little booger right here, the fear of missing out. Because that can cause investors to make riskier choices than they otherwise might, like entering at areas beyond the favorable large triggers. It includes getting in early. Hold on. Right? We're getting in late, waiting for that confirmation when everything is great. But what it does is that little bit of confirmation, ladies and gentlemen, that little bit of confirmation when it's not perfect gives you the opportunity to not get run over beyond those triggers. The little bit of confirmation gets you in and your risk is established. And from 51.6, it doesn't do anything. But at least when that second higher divergence prints, you're probably out for less of a loss. Does that make sense, Andy? I love your large chart read. Your large chart read is fan-freaking-tastic. But if it's not your best trade, guys, it's cool waiting for confirmation. And maybe I don't talk about that as much as I should, but I'm starting to see it a lot. You guys are becoming outstanding chart readers, and because you are, maybe we can take it. And then isn't this beautiful? When everything is perfect, there's no reason to wait for confirmation. There's the other side of it. That's okay. And Andy, it's repetition that does it. Momentum and path good, and you just weren't in front of it, and you can't be faulted for that on this one. But you went back and circled it, and you see that that was perfect, right? That this isn't one of those trades where we're waiting for confirmation. This is one of those trades where it doesn't get any better. Let's take the trade and let's be awesome with it. And guys, I want you to see how much this market jacks with you before it hits the perfect entry. Because the mid band was down here when this one happened. It dances. These fluctuations will give you heartburn. And yeah, that's okay if you're watching something else. It just wasn't your trade. It wasn't meant to be for you. But you still went back and studied it. And the mid band was the only area. And look at that. It bounces off of the triggers. And the rules say don't take it from the triggers, take it from the area. And it bounces off of the triggers. And the rules don't say let it bounce off the triggers, bounce off the area. And then sure enough, it gets to the area inside of favorable large triggers and off it goes and it becomes easy. Guys, that's hard to sit through because your fear of missing out will absolutely crush you. Andy, it's great trades. They're great chart reads. And I think that you provided us a pretty awesome lesson for being a little bit patient or insisting on confirmation. So thank you for that. All right, Adriana. Placed entry, didn't take it, not your money. Oh, virtual hug right around your neck. One of the hardest things to do is when it doesn't hit your entry, you just saying, it's not mine. Adriana, outstanding. Guys, how hard is it to not get your entry and then watch it go exactly do what you thought it was going to do? Adriana, I want you to buy yourself a beer tonight and pretend it's from me. Great job. Rules not met, not my trade. All right, Joel. Great bottom, 50-50, no divergence, perfect entry, and it just didn't work out. I can't find a fault with it, Joel. Perfect bottom, odds favorable. It's a 50-50. You didn't trade into a termination. That one totally had the potential to break, and no divergence kind of sealed it. And then it is split triggers. And you got in between the correction points, right? And maybe when it's split triggers, waiting for the confirmation off the synthetics, it keeps you out of the trade. So there's a lot. There's a lot of confirmation opportunities when things aren't perfect, guys. Is anyone else seeing it? Are you guys beginning to recognize that theme returning over and over today? You lost that one? This one, D-Rock? Cool. Okay. Split triggers. This is, you know, one thing that my brother told me once, and I thought that it was pretty good. He goes, man, when I have split triggers, when my reversal bar is already into the large triggers, he goes, I'm going to wait for a reversal bar off the synthetics. He goes, it just keeps me out of a lot of trouble. And that's rung in my head for probably years now. Because when they're not one on top of the other, the correction point gets huge. And I don't think that we use the language enough. What are the triggers? The triggers are where the market is likely to correct. And that entire blacked out area is where the market is likely to correct. And we don't know where. But we got pretty lines, and they're not even in the correction point. You've already exceeded the first correction point, and you haven't even made it to the second yet. So I think a lot of times using the language, what are the triggers? The triggers are my correction point. And then what do I expect? I expect an area inside of that correction point to give me a bounce. All right. Not my money, did not pull back far enough. Now it's reversing down at the fib and it is a large fib. Well, and smalls came inside the large. So, and again, for you guys looking for consistency, not my money, didn't pull back far enough. Joel, it's just a chart read. It's just a chart read. What you did is you took a good look on a 50-50, and what I did is I said, let me show you this little nuance thing so that you can begin to apply it with a little practice. Had nothing to do. I don't have any rules about split triggers. All right, guys. Do I have odds favorable momentum at the time of the pullback? What do you guys think? And I hope you guys realize that what I'm doing is I'm breaking these down to the absolute most basic high probability. Let me talk about advantages. Don't have odds favorable. Do I have a clear path? These are the questions that I have to ask myself every time I'm looking to enter the market. And not because it'll necessarily kill it. No, actually, Walter, I hadn't reached Fibonacci support yet. I'm going to go ahead and give it the clear path. Is that cool with you, Walter? It got close, but it didn't make it. Let's go ahead and give them the clear path. And then one more time, area inside of favorable large triggers. So there's my triggers. I don't have any areas. So for me, that's a no. And all that means to me, and I don't tell you guys when to trade, is I've given up 66% of my high probability trend trade advantages. So it probably can't be a high probability trend trade. Would you guys agree with that? I don't have momentum. Can't be a momentum trade. Are you guys comfortable with that? Not a long off of a term It can't be a high volume area trade. So far, so good? Not a short off of resistance on the large, so it's not an edge trade. And guys, I do this. This is how I speak to myself when I'm trading. What are my advantages? And that's always my first thing. What are my advantages? A clear path is my advantage. That's it. So I have to say to myself, well, it can't be a high probability trend trade. That's okay. It doesn't mean that there's not a trade. And then I have to say, well, maybe I'm looking for a momentum trade. Well, no, I can't because there's not momentum. So I know that I'm not just jumping in because I don't have the momentum. And I'm certainly not going long because everything is down, so it's not an HVA trade. And if I were to take a short, it would have to be from up here at a large chart resistance, and that's what we call an edge trade. And it's not even an edge trade. So if this is the process that you run through every time you look at your charts, I don't have odds favorable momentum. I don't have a clear path. It's not coming from an edge. It's coming from the dead center. So what kind of trade would it be if I decided to go short when my triggers don't agree? And if I can't name it, well then how do I manage it? Pedro, edges. Basically, guys, what an edge trade is, and it takes a higher time frame chart to trade it, is when everything is screaming down and you pull back to Fibonacci resistance mid-bands on a large chart. There should be a 21.3 that's odds favorable. It's a trend trade from a higher time frame is all that it is. But I'm not doing this to talk about it. And Andy, I love that you didn't find a trade in here. But the reality is if you guys talk to yourself about the advantages that you see, if you guys try to place those advantages and define the trade that it is, more often than not, what you're going to find is that you'll say, you know what, I think I was just making an opinion here. I think I hoped that it would go down. I don't really have rules for it. I'm just going to sit on my hands for a minute. I'm going to wait a minute. I'm going to wait until it's absolutely perfect because, guys, that's when they're easy, is when they're absolutely perfect. So I hope that made sense. Saw the reversal at support. All right. Waited until the small triggers crossed the large triggers. Momentum. Looked to be a 50-50 with momentum. So you went to the small chart to buy a position on the pullback at the mid band. Blow past the mid band. Stops you out. All right, TLC, let's do a couple lessons here. The first lesson, 2 divergences on a 50-50 is financial suicide on the NASDAQ. It rarely works. So you're absolutely right. While your entry's in the right spot, everything looks good. 2 divergences on a 50-50 is horrible. And that's okay. And then, yeah, I know. I'm agreeing with you 100%. But I'm going to escalate on that just a little bit because here's your next NASDAQ lesson. Do you see how strong against you the small triggers are there on that 50-50 with 2 divergences? I say this every day until I'm blue in the face. When your small triggers are less than a full bar away, when they are strong against you, and TLC, the reason this is a thing, oops, I killed my ninja again, son of a gun. The reason this is a thing is because your small chart on the NASDAQ is a large chart on any other time frame that you're trading. Does that make sense? The small chart on the NASDAQ is a large time frame on any other market that you're trading, which means Let me see if I have an odds favorable momentum on a large chart real quick. There we go. Which means that, do you see this trigger look right here? You'd never go short against that, right, TLC? That look, you'd be like, hell no, that's strong triggers. But our brains forget, I know mine did to the tune of blowing out multiple accounts, that's the same look. Like that's really strong triggers down against. That's a great momentum look on a smaller time frame. So one of the things that you can do on the NASDAQ is you can simply avoid entering against small triggers. And I want you to see something too. If you're patient and you wait for the close above, and where was your picture? Sorry. Your large chart was screaming to the upside right off of support, right? That's a great look. I love this look for a 50-50, especially off the terminations. It really is an outstanding look, TLC. Two divergences said, let's be patient. Strong triggers said, let's be patient. But if you took the close on the correct side of the small, if you allow yourself to get to the other side of the momentum indicator, well, then you at least got paid at the trouble spot and maybe went break even. And it either goes or it doesn't. Does that make sense? And I've put this into the spreadsheet that I give out every day. And when we talk about entry thoughts, hold on one second, D-Rock. The large chart rules don't change. But when I get my reversal bar, I'm looking at the location. Where are my triggers in reference to the reversal bar marker? And if they're below it, as I get to the area, I sit on my hands and wait, TLC. And that's the, okay, let's incorporate a little bit of patience. And if they are above it, when I get to my area in question, well, then that's my, all right, you know what? The smalls are a full bar away. I'm going to get in at the area because it's likely to suck back because this is a 13-2, not a 5-1. I hope that makes sense for you guys because I have killed so many NASDAQ accounts fighting small triggers. And I've missed a lot of great trades, fearful of them, when they were still a full bar away. So I've gone through and man, I've put all that into here on that spreadsheet that I give out every day. And then my brother did this for you guys. I really think he did this to make it a lesson for you guys. If the triggers are above on the pullback, then take the trade. A full bar above, TLC. I want you to see this, guys. Divergence prints, it may go lower. The first entry, the triggers aren't a full bar away. It gets stopped out. The second entry, small triggers are against it, gets stopped out. Go again because I'm so damn smart, gets stopped out. Go against them again, it gets stopped out. Against them again, stopped out, stopped out, stopped out. First close on the correct side, easy money. Pulls back to the area, small triggers are a full bar away, easy money. I really think that John did this to create the lesson for everybody. But this is my favorite safeguard on the NASDAQ. It just requires a little level of patience, guys, and this is NASDAQ exclusive. But what happens is instead of losing 6 trades, you just sit on your hands and wait and then get in at the best one and get paid. And the same thing I believe was true on your trade, TLC, is there was the opportunity if you just waited for the correct side to at least get something out of it instead of getting run over. But it was a good large chart read. It was a great large chart read. And then D-Rock was the first one up on the last chart. Are you talking about this one? I don't know. I don't have any sort of range bar chart. I don't have any sort of market flow chart to let me know. I just can't answer it intelligently. At 81.01, I'm at the tail end of momentum. I mean, it looks like it could be good, but without seeing a range chart, what do your rules say, brother? I hate that word enough. Then take the trade. See how easy that is? If you like the look, if you're comfortable with the look, take the trade. Me personally, without another chart giving me some sort of advantage there, it's just not my trade. I love the strength. I love this, but that bar up is on the wrong side. Then that makes sense, doesn't it, D-Rock? Then that's a perfect look to get you through, letting the large chart lead the way. It's annoying how I always go back to rules, isn't it? And then D-Rock, the same idea here. 50-50, great bottom, beautiful. Show me a picture. You're making me guess too much. All right, and for you guys that took my brother's class, yeah, amen, Bob. So there's your 50-50. There's your split triggers. And then D-Rock, this is one of the greatest things ever. Do you notice that you're coming off the outer band? And not only are you outside of the outer band as you come back in on a 50-50, you also have a breakout bar coming off of the outer band. And if you've ever talked to John, and I know that he says this a lot, if I get a white bar off the outer band, I have to wait for market flow confirmation. I won't just enter the trade. By the time you get to your entry area, those fast triggers are against you strong. And you don't get to the right side of them until all the way down here. And guys, this is one of those examples of not utilizing the tools, not having a complete set of rules. And D-Rock, I'm not saying that you don't have a complete set of rules, but you missed completely that a breakout bar off the outer band says wait for confirmation. And I know that he teaches that because I have it written down on a piece of paper somewhere. And then the next one is you were so excited about the long that you fought the triggers, even if you weren't going to wait for confirmation. And it's crazy, guys. I love the market flow chart, and I just don't fight those. And I know that he talks about it, but this is where incomplete thoughts cost money, right? Incomplete thoughts will cost you money. And then D-Rock with the split triggers, with the challenges here, with the 50-50, there's another one of those instances where I say, it's okay to wait for confirmation. It's okay to get some sort of reversal bar off that area that you're hoping holds. Because there was a lot, especially when you incorporate the next chart, there were some challenges with this one, without a doubt. Does that make sense? Without the benefit of the range chart, it's a 50-50 with split triggers. Confirmation's a good idea. And then once you start giving yourself extra information, you have to be willing to use it. And sometimes that means missing a trade or holding off and not taking the trade where you think you should be taking it. It's a great large chart read. All you guys that took that trade, it's a great large chart read. But when it's a little problematic, it's okay to insist. So odds favorable, 50-50. No divergence, pullback, rock star entry, first target divergence prints gets the hell out. Andy, my arms are wrapped around your virtual neck right now in a loving, no need to call HR manner. Guys, this is how you take a 50-50 trade. Not a good bottom, though. That was an incomplete thought at the bottom. It never made it. All this momentum said it had the potential to break, right? And then, Andy, I really want to cover this one because this is twice. I want you to see something amazing. Was really worried that these red fibs would hold up. So there's two ways to look at fibs in the distance. The first one is if price hits it, it's a term. Until price bars smack full tilt boogie into those fibs, they are targets. Because remember that it is the idea that price reaches the area sets off the decision-making process. This killed me for the longest time, Andy. It really did. And guys, I got to tell you that all you're doing is you're going through the perfect path, is you're making little subtle mistakes. Your large chart reads are great, and now you're learning that nuance a little bit. But one of the great things, and I think I can use this one exactly on both, is when I'm looking at this chart, and let me take the picture of it. Here, I have $70 worth of profit to get there, right? I'm close, but I haven't hit it. I still have all the momentum and I still have everything out. But when I get in at the correct spot, now I have like $270 worth of profit. So that little helpful thing, the difference between a target, and you know there's a picture for it in here, the difference between a termination condition and a target. Price reaches, no triggers, it's a term. Price is not reached, it's a target. And that's on the spreadsheet too, guys. Y'all should really click through all of those. But Andy, your job on this one was absolutely amazing. Rules met, no divergence, everything looked good, perfect entry, low risk. And your window of opportunity was pretty wide, but you took it right from the top, right where you should with all that momentum. And you got paid. You didn't sit and hope. And then once that divergence prints, you're like, hell no, I'm not keeping risk on this one. So I want you to celebrate everything. This is just a great conversation, but the trade is a beautiful trade. And man, you're going to get the fear of missing out. It's a part of it. It goes away eventually. David, how are you, sir? All right, Pedro. Long-term downtrend all day, current uptrend to counter can trade in the big scheme of things. I disagree. I disagree, Pedro, because I don't worry so much about long-term anything. I'm looking in the moment always because there's so many moves within the big moves that I believe we can take advantage of those without a concern of the huge picture overall. Now, if it was 150 bars in the same direction without an up bar, I would agree with you probably 100%. But because we're seeing all these fluctuations, it's creating a lot of opportunity. So is it reasonable to say when price is below the mid-band that it's best to look for short trade opportunities or maybe use a larger scale chart? So you found even though strong up momentum on large chart, the trend tends to reverse more easily. Mid-band acts as resistance. So Pedro, let's do this. Man, you guys hate it when I do this, but I love it. Okay, so let me go to the first and obvious. Let's address the elephant in the room, Pedro. Is you haven't shown me one picture, not one trade today, to where we could discuss it, right? So it's difficult for me to validate your opinions if I don't know what you're doing. And it may not be that it's a downtrend. It may be that you took trades that broke rules. So this is a bad bottom. It never reached Fibonacci support. And then this was also a good bottom. This is great, but the gap theory continued the move down. From the bad bottom, all that momentum is still just a 50-50. And off that 50-50, well, I didn't get it in the picture, there is divergence, which means that it's not a high probability. It's not even the best of the medium probability looks there. So what you run into is it's easy to say, man, because it's a downtrend, I'm getting my ass kicked every time I try to go long. But you still have to make sure that the rules are in place, right? So I'm looking for long trades, and I don't see one there. And I don't see any opportunities there, nor do I see an opportunity here, and there hasn't been an opportunity here either. So maybe it's not the downtrend that's getting you. Maybe, perhaps, and potentially, that you're taking lower probability trades that are running you over. But if you made money with odds favorable and a clear path here, you're pretty happy. And if you took, let's see, if you made money here with a clear path, you were pretty happy. And if you found a way to catch that pullback, you were pretty happy, right? Just trade with what it is, but make sure that the rules are met. And I appreciate you putting that in the room. But what we run into is that you've got to make sure the rules are met too. And I have days where I'm 50% down and 50% up trades, and I'm still doing well, even if the trend is overall an up day or a down day. And let's just look for grins. Man, I've got so much stuff here. This is crude oil. And I guess we could say overall it's been a down day, right? Take care, Cav. We came off of a termination that started the push down, and it's kind of been going down ever since. So let's see if we can find any longs in there. That was a 50-50. Let's see what this 50-50 looked like at 10:30. Pushing off of the perfect termination. That's not even a terminate. That's into resistance. No, not a lot of, I'm not seeing any long opportunities today. Maybe this one right here at 7 in the morning. But it's still not really a great look. It's just a momentum style trade. Does that make sense though, Pedro? I don't care for always feeling like I need more indicators. I don't care for always feeling like it's I could go to a 55 chart, right? Let me build one real quick. Let's have fun with this, guys. And one of the things that's kind of funny, not funny, it's interesting to me, is that rather than saying, for me personally, rather than saying, well, my rules aren't met, I'm more inclined to say, how can I adjust my rules to find an entry? How can I break my rules to get into the market? And you're absolutely right. That's pretty much a downtrend all day, right? That's a 55. And there were pullbacks on it, so maybe on a higher time frame we could do it. But we're so much better using these 13.2s. We're so much better using these smaller, faster charts that we can get in. And you can definitely make money. I won't say counter trend. Yeah, counter trend to the daily trend, absolutely. But yeah, you've got to make sure that the rules are in place, and you've got to make sure that you have those advantages. So you have to realize that the first one's a good shot, and that divergence ruins it, right? So you let those little red flags keep you out of the problematic ones. And it all goes back to that simple phrase, either your rules are met or they're not. Either your rules are in place or they're not. And most of the time when we're upset about not finding a trade or something, it's because our rules weren't really met 100%. But it still did what we thought it was going to do, right? I think the market's going to continue down because it's an overall daily trend. So I'm going to skip the perfect long trade, or I'm going to take the aggressive short trade because I believe that the overall daily trend should fuel the fire and get me where I want to be. But you can really just kind of say either my rules are met or they're not, right? Either I have my advantages or I don't. And I think that we just circled full back to how we started class today. Is the easiest way to get to where you want to be is to always trade with a statistical advantage. And your rules should provide you that statistical advantage, no matter what it is. Forcing gets you into trouble. Opinions get me into trouble a lot. Um, and Pedro, I'll show you. Oh my gosh, I want to show you this because you'll probably get a kick out of it. I think everybody will. When I have this day that appears to be down all day, right? And I have formed the opinion that shorts are infallible. Let me show you how my day goes. I have decided that shorts are the only option because of the trend. So I go short right here where it's not perfect, and it whips me. And then I go short at resistance because I believe resistance should hold, and then it whips me. And I go short here, and it whips me, right? And then I'm dejected, and I miss this one, and I miss this one, and I miss this one because I really just don't trust it anymore. And then I'm like, this one has to hold. And then it goes down. And then I'm like, this one has to hold. It's an overall daily. And my rules are never met, but my opinion is full strength. And man, I've done that. Pedro, I have ruined days trying to think bigger than the charts in front of me. Hey, Soon. And I don't know if anyone else has that problem. I don't know if anyone else ever does that, forms those opinions. But I certainly have. And then when I go back and look at them, it almost looks ridiculous, the trades that I take going against it because of the opinions that I form. So this is the NASDAQ, and the NASDAQ's coming off a termination, and it's a 50-50, right? And divergence printed, and the triggers are split. Is it okay to not be in that short trade even though it went down? And yeah, Pedro, and you can be more careful, right? But if trends end all the time, I guess is what I'm saying, is trends end all the time. When you look at what the NASDAQ did this morning, I mean, the NASDAQ was just up, 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 up. And if you look at it, the NASDAQ has really been on its way up for a while. But there was so much money to be made on shorts in there. There's so much money to be made on shorts. And eventually the up stopped and it goes down, but the rules keep you out. And then when it starts back up, it begins to get easy. And I guess that's all I'm saying is don't worry about whether it was up or down for the day. Just make sure that your rules are met. And if it's high probability to the upside, even though it's been down all day, manage it like a high probability trend trade to the upside. And if it's a momentum trade to the upside, even though it's been down all day, manage it like a momentum trade to the upside, no matter what it's done all day. And if it's a medium probability trade to the downside, and it's been down all day, don't manage it like a high probability trend trade. Manage it like a medium probability trend trade. So knowing what you're getting into pays huge dividends. Pays huge dividends. Cool. And thank you for bringing that up. Guys, these are the things that when you bring them up, when we get to have conversations, I get to give you my 2 cents on it. And guys, my 2 cents is worth everything that you pay for it. Absolutely nothing. My opinion is just based off of observation. The way I teach you guys to read the charts is based off of my own shortcomings, my own problems that I've had learning to trade the charts over the last couple of years, whether it's fighting triggers on the NASDAQ or whether it's trading in determination conditions. I have jacked it up 1,000 different ways to Sunday, and I just try to keep you from doing that. All right. Absolutely, Jen. Reversal bar prints, right? This is the beginning of your pullback. Are you comfortable with that? Of course you are. You're Jen. After the reversal bar, I have to look from the bottom of the triggers to the top of the triggers. Holy shnikes. That's a huge gap, isn't it? If this is my correction point, doesn't it make sense that it could go from here or here or here? So when the triggers are split, look at how big my window of opportunity is. And then the flip side of that is when they're one on top of the other, there's less room for that bounce point. My risk goes way down. My confidence in where the market is more likely to continue goes way up. So what you do is with split triggers, and we talked a lot about confirmation today. We talked a lot about confirmation when they're split, and let me find them real quick. I have pictures for everything, guys. Go through this. Go through this spreadsheet. So here, Jen, I don't have a care in the world. I'm like, man, that's it. Look at how small and easy and concise and beautiful that is. And here I have the large triggers and I have the synthetics. And what we talked about today is when they're split, when it's ugly, wait for a reversal bar off the further point, right? Especially if you get to the wrong side of the first one. And there will be times where it'll go right off the first one. You're like, oh, I was waiting for the second one, but you got to be cool with that. Does that make sense? So the tighter they are one on top of the other, the easier it is to get in. The easier it is to grab those great entries, the easier it is to reduce your risk, the easier it is to do all the wonderful things that the software allows you to do. Price reached Fibonacci support. None of the triggers broke. There's your third divergence in the same price range. The synthetics are, yep, so your synthetic triggers, Jen, watch this. If I put a circle on the large triggers from the large chart, that's all they are. Oh, crap. So when they're trending one on top of the other, it's just everything's in sync. And guys, all this stuff that I talk about like it should be second nature shouldn't be. It should not be second nature. It shouldn't be common knowledge. It shouldn't even be obvious if you're brand new. But what I'm telling you is the more time you focus on identifying patterns and the more things you see, and most importantly, Jen, take pictures of them, right? Take that picture and remind yourself that triggers are a correction point. And when they flow one on top of the other, your correction point is much smaller. And use language that really addresses what it is that you're looking at. And I think you'll be floored, guys. I think you'll be floored at how quickly you become smart and a great chart reader. Ron says 50-50 failed. Larger up, smaller down, divergence prints. Let's get back to the reversal bar marker. Don't think it's cool is good language. One for Pedro. Counter trend, white bar, really shouldn't work trade, not a beginner trade. Divergence is the first signal. Wait for it to clear. Small, mini bazinga, slow day. Nice. Nice, nice, nice. I love that you say shouldn't work. How's that for talking about low probability? Still a termination. D-Rock, you're trying to find every trade. You're trying to find every move. And when one goes, you're pissed off that it doesn't. I recognize this. Here's the deal, D-Rock. Is it a termination condition? You said it was still a termination condition. What do your rules say? Do your rules say from a bad top trade directly into a termination condition? My guess is that they don't. Do your rules say it doesn't matter if none of the triggers have broken through said termination condition, I have to take a trade? That's not in your rules either, right? And I know this. So D-Rock, your brain says, But it worked. WTF. Maybe I need to change my rules. You don't even have odds favorable momentum here. The faster inside. But because the market did this, you've questioned everything. Does that sound about right? So here's the biggest challenge, D-Rock. That's not what I wanted to do. So let me try this. Hold on. Here's the biggest challenge. We'll use this one. All right, I'll do it like this. Son of a gun. I'm going to get this, I promise. The fluidity of this lesson just went away completely. Is that market flow chart has you forgetting that the large chart leads the way. So much so, D-Rock, that you put it in between the second chart you're supposed to look at. You so want to find a trade on this chart that you don't even look to make sure the rules are met over here before you look at your market flow chart. Hold on. And then this is where you have to ask yourself, is that my best look for a short? Take care, Ron. Is that your best look for a short, D-Rock? Isn't that pretty easy when you put it in those terms? And what you're doing, brother, I can't stress this enough. This is normal. You get excited about new toys and you want to play with them every way possible. If you get a brand new kite, you will run full sprint for 18 hours trying to make it fly when there's no wind, right? You get a brand new bike with 2 flat tires, you're going to ride that thing anyway because you just got a brand new bike. And that's what you're doing here, is you're so excited about a pattern on this chart that you're forgetting that this chart has to lead the way, right? So let's look over here. No, I was looking to see if there was another one on the charts, but there really wasn't. But I think that that's great. I think it's great that you're dropping that in the room, because what you're going to find is that sometimes, and man, I hate to quote my brother when he uses such horrible language, but sometimes you have to step the F back and look at the big picture so you stop trying to micromanage everything. So the synthetics are way down there, right? And they're not even green yet, Jen. And the challenge is, Jen, what do your rules say, right? Like, what kind of trade are you looking for? You have a termination, you have immediate momentum, and the synthetics haven't rolled yet. Are you willing to take a shot because of the termination with all the momentum to go up? But if you keep it in real simple terms, can this look ever be a high probability trend trade if the triggers don't agree? What do you guys think? If the synthetics are down and the larger up, can it ever be a high probability trend trade? No. Does it mean that there's not a trade? Of course not. It doesn't mean that there's not a trade. It means that there's not a high probability trend trade. If I'm on the momentum side of my small triggers and I get a snap back to 1-to-1s, is there a potential trade there? Absolutely there is. But it's not a high probability trend trade, and that means that I have to manage it differently. That means that had I gotten that little snapback, I might have taken a trade. It's not even a medium probability trend trade. It just would have been a momentum style trade. And now I've got a 50-50 look from a good bottom. And now if I get a pullback, my highest point of support, I've got a mid band above it, but I'm really kind of down here. And notice that it corresponds with a pullback to the synthetics. There's no divergence, so there's really two spots. I might be willing to take a shot at the mid band because it's right over the correction point. But with my large triggers so far away, it almost makes more sense to wait for the lower push. I'm not sure which it's going to be. So I'm going to watch, because this is NASDAQ, where are my small triggers when I get to my first area? And if I never get to my first area, guys, it's just not my trade. Does that make sense, Jen? And I don't know what this is going to do. It may go up from here, and if it does, I don't have a rule met. I don't have anything in my plan to take it. And then if you're one of my market flow users, I'm on the wrong side of small triggers turned against me, fast triggers turned against me. So even though they're strong up, I'm on the wrong side and they're trying to turn down. So you're kind of caught in this little area. If you were going to go long here, you had to be in at 76 flat. And you have to be willing to manage it when it gets back up here. And you have to wait and see if something changes. But I don't have to be first, especially when my large triggers are all the way down here. That's a pretty good look for things to potentially snap back. Let's see if it pushes down from here. And guys, this is all we do every day as we talk about these patterns. From the bottom of my heart, thank you everybody that posted in the room and had to sit through me talking about challenges. I know that's hard to listen to sometimes. But I hope that you find that when I do talk about challenges, I throw fixes, and that's what this room is for. Challenges are okay, but we have to have fixes. Gino, you can do whatever you want, brother. You can completely ignore the window of opportunity if you want. You can completely jump in at a fib if you want. You can, hell, you could go short there if you wanted to. But I don't have any rules, Matt. And now I'm at the top of the window, and my small triggers are getting below the reversal bar marker. And again, if you are one of these guys, I'm below these triggers down. That's not a full bar in my book. And then D-Rock, it fights the fast triggers right now. So let's just see what happens. Let's see if it closes back. And if it gets all the way back here, we may have to rethink things. But if you go from the top of the window, once again, you have to be prepared. You have to figure out what your management's going to be. So Gino, you could have gone from 76, but your stop still has to be down here, right? And now those small triggers are getting below the reversal bar marker. And guys, give me a Y if you see how they just acted as resistance. NASDAQ killer, ladies and gentlemen. Strong triggers, clear path, one up, one down, easy money. Isn't it crazy, D-Rock? Strong path, or strong triggers, clear path, odds favorable, one up, one down. Why not? Why wouldn't you? But the large chart said go, didn't it? The large chart said go. The large chart said look for it.